Ladies and gentlemen, welcome to a very special episode, which is the SoFi earnings, which is on Friday, actually. Usually this is a Monday. With me today, I have the great and powerful Tevis, with a little lights off, early morning, I guess, eh?
Coffee is not here yet.
What?
My coffee's not here yet. It's on the way.
You got to get the coffee. Roy's here as well. Roy, how you doing?
Got my coffee right here.
Monster at 6 a.m. I think it's 5 a.m. where you are, right?
Yeah, it's about to be 6 a.m. Yeah, 7 a.m. for you
Gotcha.
guys. So yeah, I'm off today. It's fine.
And then we also have the great and powerful Neil, couch investor. How you doing?
Good morning, guys. I mean, I'm fine. It's afternoon here, so I'm good.
Yeah.
I've had coffee. I've had a milkshake. I've had everything so far.
Rub it in, why don't you?
Yeah, seriously. So earnings are going to come in fast and furious here in about 4 minutes. We are going to get SoFi earnings. We'll go through that presentation, the press release and the presentation, which is going to have Anthony Noto's commentary, comments about hopefully next quarter results, which is honestly, I'm going to take a quick look at members, revenue, EPS, and then I'm scrolling right to guidance. So
we got some confirmation that people from SoFi's actual team are watching this show. Chris Hager just said, "Good morning, everybody."
Oh, that's not what I thought you were going to say. I thought you were going to say confirmation that Kevin Warsh got nominated for.
That too. That one's less exciting though.
Or Fed chair.
That one. Yeah, not that exciting.
That's not why we're here. It's SoFi. Let's see it.
SoFi it is.
Market's a little bit red. So I picked this shirt in the dark and it happened to be red. And I'm like, go figure. I don't think that means anything, obviously, but it tends to amplify the moves on the stock. I think it'll be a great earnings. I think that will be green. We'll have to see. But it is a red day, at least to start.
That's funny. You have like a basket of shirts. You're just like, whatever's on top, I'm putting on.
Well, I'm married, and at 5:30 in the morning, turning on the light. If I don't want to die early, I better just pick a random shirt off the top.
Sure enough. Okay, let's make sure that we have the website open. Whoever can get it first, please send the link through the private chat here, and then we can all pull it up. And then I'll share it on screen and everything.
What are our predictions? Beats across the board, stock drops, or beats and we go up for once?
At
Beats
least
across the board.
I don't know
Beats
what
across the board, and then stock ends up raising. We're in the dumps for too long. Maybe we have a broader market sell-off, but like, I don't know. Stocks can trade green whenever the markets are red. Meta showed us that the other day. So I think SoFi might do that. Tevis?
Yeah, we're going to start off up, but I don't know what we end off at. It really depends on the macro. This can get dragged down. I mean, you saw it with Tesla on Wednesday, right? It started up 4%, 5%, and ended the day negative, I believe, or close to it. So it's just the macro.
Okay, let's keep an eye on this. This should be releasing in the next 30 seconds. Roy, what's going to happen?
Yeah, I mean, we'll see an initial pop. Don't read too much in that pop. It can oftentimes fade the other direction, up or down. But yeah, they're going to post great earnings.
Neil?
Anyone know? I mean, I think it's a beat across the board. As for guidance, we technically already know what the guidance is for 2026, so it's more about comments on the range. But then again, it's the same guidance as before, while we are now after 2 dilutions. So I guess it's still good, even if we come at the midpoint of 67 cents or whatever. I think we're going to be fine.
We're initially up 1.3% right now.
Yeah, and on those too, like if this is your guys' first time following an earnings live, don't read too much in that. That initial move doesn't
All
mean
right,
anything.
numbers are out. 13 cents EPS, 1.013 billion. Beats across the board.
There you go. There you go. Okay, members. SoFi's up 3%. SoFi is up 3 freaking percent already. We'll see if this holds. Okay, we've been dragged through the mud for so long. So I'm hoping that we see a good day. This does not mean much. This is tiny volume. You know, we have to wait till the market actually opens to see how the stock is going to react.
13 cents EPS is actually lower than we were all thinking.
Not
And
me. That's exactly what I thought.
either. Yeah.
Oh, yeah, really?
Yeah, I was up.
Yeah, you were the most bullish.
Okay, well.
Yeah, we overlooked Tevis probably the PSUs for 25 being granted, at least I think. So it was
member wise, did you all think $1 million or something? Close to $1 million?
I thought so, yes.
Yeah, just over $1 million.
Not net, but gross. Yeah.
Yeah. Let's see here. Where did you get those numbers? I still don't have them on the page.
They added over 1 million members. Hold on. Okay, I got it. Adjusted net revenue up 37% to 1 billion. Member growth up 35% to 13.7 million.
All right, can you share this through the private chat so I can put it on screen?
Yeah, sure.
Okay.
It's not up on their site yet, but it's up.
Not up on their site just yet.
Yeah.
2025 was a tremendous year, and the fourth quarter was nothing short of exceptional, delivering more than $1 billion in quarterly revenue for the first time in our history, said Anthony Noto. Our one-stop shop is scaling exactly as intended and delivered a winning combination of growth and returns. We added a record 1 million new members this quarter and drove record product growth. At the same time, we moved with urgency to lead the next phase of financial services by delivering crypto and blockchain innovation backed by bank-grade stability and security. This combination of scale and innovation and profitability positions SoFi to drive durable, compounding growth and deliver superior financial returns in 2026 and for the years to come. Let's see what the guidance looks like.
Can you throw up the report? The deck is not out yet, guys. We're up 5% in pre-market. And more importantly, my coffee's almost here.
Yeah, up 5. I just don't really like this freaking the way it's being shown, but yeah, I can throw it up. So it looks a little weird here. We'll get the actual report, but Jesus, freaking annoying thing. Fee-based revenue up 53%, adjusted EBITDA up 60%. Product growth actually accelerated faster than member growth, which is always great to see, higher than I expected. Announced 2026 guidance and medium-term guidance. So we probably got 2028 numbers here. Let's go ahead and see.
Just above lending, you get just above the lending part, you will have the 2028 a little bit. Now you've passed it.
It's in here?
Just above the part where they talk about lending originations and average balances, you will have, voila, here. Over the medium term, management expects this part.
Net revenue of at least 30% from 2025 to 2028. I mean, that's pretty strong. Additionally, management expects to deliver compounded annual growth in adjusted earnings per share.
Chris is saying Noto's on CNBC in 5 minutes.
Okay.
So maybe you can.
Yeah, I'm doing it.
That out. Cool.
Yep. Additionally, management expects to deliver compounded annual growth in adjusted earnings per share of a 38 to 42% from 2025 to 2028. This guidance assumes that there's no meaningful change in macroeconomic environment, no significant new business launches or acquisitions. Once again, that was just like 2026.
Yeah.
But what was a full year guidance? Is it right around here, or did I? Okay, looking forward. Management expects the increase of total members by at least 30% year over year. Management expects to deliver adjusted. By the way, this is a stronger guide than what they originally gave for 2025.
That's actually insane. And these are after large numbers.
After
So,
large, yeah, exactly. Net
business.
revenue, which implies 30% annualized revenue growth. Adjusted EBITDA margins of approximately 34%. That is higher than their long-term guidance of 30%. Net income of approximately 18% margins. Lastly, we expect EPS will be approximately 60 cents per share. I'm a fan of this guide. It's not like, obviously they need to be conservative because they need to, like, they're still going to beat and raise, but at least it's, they're showing 30 handles in front and saying, hey, we're not looking to grow in high 20s, mid 20 ranges. No, we're looking to grow at 30+% rates, at least 30% year over year.
Yeah, I think this is what we were talking about last night with guidance. I actually think that they're being as conservative as always, except they see a little bit more favorable macro and they see that they're absolutely killing it. And so they must raise. I still think that this is pretty strong sandbagging. But yeah, it's a nice increase. No complaints.
Wow. Stock is up 4.8% right now. We'll see if it holds, but yeah. Neil, what are your first thoughts?
I mean, I was not that aggressive with my predictions, but I mean, they surpassed it quite easily as always. The guide is great. This time it's not, 1 year ago, the guide that we've got at the start of the year was like, okay, we knew. I mean, it was super easy, very, very low ones, growth rates. At least this time they're starting the year with a bit more aggressive guidance. But again, we know that if they give us these types of numbers at the start of the year, then 12 months from now, we will look back and say, okay, they've raised guidance 3 times already. So, 2026 looks like it's going to be another amazing year for the company. So, as always, no complaints here for SoFi, contrary to what might happen on Tuesday, Roy.
Yeah, it's the pain.
What's it called? So it looks like from the technology platform, most likely we did not see a $33 million increase from Chime.
122. Yeah.
So
if they did, that's abysmal. So I don't think that I had, I think, 156, 157 with the 33 million in there. So that would be right in line. If they didn't receive that for some reason, that'd be coming probably the next quarter then.
Wow, look at accounts.
Decreased.
Yeah, down 23% year over year to 128 million.
Yeah, but that's probably Chime or yeah. Honestly, the technology like Galileo and Technisys have not been good.
No, but they were at 157.8 in Q3 and million accounts, and now they're at 128.4.
So so they do say it includes the impact from a large client which fully transitioned off the platform. So I guess.
Yeah. I mean, there's definitely been rumors that Robinhood was leaving the platform, that Chime was leaving the platform. From what I heard is that a lot of these, larger institutions do not want to end up giving a lot of their data over to one of their larger competitors, right? They try to build it in-house. They try to build it with a company that doesn't also have their own, business in the same space. This is why they're transitioning over to, United Air and Southwest Airlines and T-Mobile and all of these, because they're not competitors, and so they don't feel threatened by, using their product. But also, Anthony Noda will talk about it in the call. It's not just about the.
It's on CNBC right now, or not yet?
No, it just says commercial break right now. Yeah. Okay, let's see. Total fee-based revenue across the business surged to a record $443 million, up more than 50% year over year, now generating nearly $1.8 billion on an annualized basis. This was driven by strong performance on the loan platform business, which generated $194 million in adjusted net income, up 15% from the third quarter and 2.9x from the prior year. The loan platform business is now running at an annualized pace of $15 billion of originations and $774.6 million of high margin, high return revenue.
Yeah, that's really strong.
Yeah, that's.
I thought we might see a little bit more weakness in the financial services platform and on the lending platform just because of Blue Owl and some issues that were there. But yeah, maybe not.
Maybe they diversified into a lot of other customers. That's the only problem is like, I still don't have their presentation, by the way. I don't know if, oh, actually I do now. Let me switch off this terrible freaking thing. Shame for making such a bad UI. Okay. Continuous innovation and brand building. They end up talking about all the products that they ended up launching. SoFi launches paid SoFi Plus subscription, AI-driven capabilities with Cash Coach, SoFi Pay, SoFi Crypto, SoFi USD. Yeah. Okay. 13.65 million new accounts. They added 3.58 million this quarter, and they said they're going to grow by another 30% next year. So, sorry, what's the math on that? 13,615. They want to get to 17.7 million members is the call for 2026 by the end of 2026 right now, assuming that we don't beat and raise. I mean, okay. New products added for the quarter were at 5.53 million, for the year. Stock still up 3.8%.
Look at fee-based revenue, dude. Holy crap.
I know. I know.
Just look at that chart. The middle chart. It's insanity.
Yeah. That's crazy. But the main part here is the fee-based revenue as a percentage of their total revenue mix, right? That's what's going to matter. Because then the people who are saying that, oh, it's risk-based revenue, and just because they're counting it as revenue doesn't mean that, it's not going to adjust later on if credit performance ends up getting worse or something like this. No, this is fee-based. This is money in the pocket. No one's coming for it. It's SoFi's. Rule of 40 was 68, faster than last quarter as well. And this is, look at this. These are the capital raises recently. So tangible book value, 8.9 billion. They did 39 cents of EPS. Yeah.
Massive.
Pretty nice. Financial services. Okay, wait. This. Oh, I got to plug numbers. Oh my God, dude. I love SoFi earnings. Whenever this comes out and I get to do all the work again. Like, look at this. Look at what they were selling their personal loans at. 106.5% gain on sale margin. And this line, this sort of black line here is what they marked it on their book as. Okay. So even though Wall Street has constantly come out and said, look how expensive their loans are. Just because you say that your fair value on your loans are this high doesn't mean that it's actually true. Like, this is what Wall Street was tearing us apart for every single quarter. And then SoFi ends up saying, okay, but we'll just actually sell those loans for way higher, meaning they're actually essentially downgrading how much their loans are worth. They're being more conservative. But the numbers are so high that Wall Street has a hard time believing them because, well, they compare it to competitors and they don't have these numbers.
And these are not little volumes either. Like they could say, oh, it's a small sample size of what. No, you cannot say that at this point. So I think that there'll still be some disbelief over the numbers, how good they are. But Yeah.
Yeah.
The only one I'm not seeing, and I know we'll get to it, like, is the tech platform. There's not clarity if it includes a 33 million from Chime or not. If it does, and I'm sure analysts will probably ask this question, that's like the one weak spot. Now, tech platform is less and less relevant as far as a revenue driver for SoFi.
Yeah.
So not the biggest bill, but it could shift the narrative a bit.
I mean,
I've been
they did
saying for
say
go ahead, Neil. Sorry.
early 2026 is supposed to be the year where we do see some growth in the tech platform, as promised. I think, what was it, 2 quarters ago or something like that? So
Yeah,
hopefully we do
Q1
get
is
some.
supposed to be quite a good quarter for the tech platform. But we'll see. That also lined up with whenever they were supposed to see Chime payments come through. So who knows if maybe they're, I don't know, sort of amortizing out their $33 million payment from Chime across the rest of the year or something. That's why we didn't.
Look at Chris's comment from 7:15 says it includes the Chime fee.
Okay, that's
It does
really
include the Chime fee.
not good. But thank you for the clarification.
Somebody says CNBC Noto. Let's hear it.
I don't see him. He's not on. Here. I'll and he wasn't on before. They were talking about American Express. So I'll keep it live. I promise you guys, I'm watching.
Did you cover guidance yet or no? We're going there.
Yeah, we covered. You didn't see guidance?
Sorry, I was picking up my coffee.
No, we talked about it anyway. 2026 guidance came in at least 30% growth on revenue, 30% growth on members. Adjusted EBITDA is going to grow at 52%. Net income going to grow at 72%. Diluted EPS of 60 cents at least. Okay. But then they also, maybe they didn't put it in here, they also did 2028 midterm guidance, and they said that they're going to grow continuously at 30%, assuming that a macroeconomic environment does not change.
That's exciting.
But how long's the Trump term? That's through 2028, right?
Mm-hmm.
Yeah.
Yeah, so we're probably not going to see crazy changes in rates or anything along these lines. So I don't know. Maybe you can assume a dovish Fed through that period. Who knows? That's speculation.
And like, banks will always be a little bit more conservative on that. They just will by their nature, and they kind of have to be. So you don't want a bank that's like constantly putting their pedal to the metal, full throttle, assuming everything's going to be great, because at some point it won't be, and then you no longer exist.
I mean,
Yeah.
they did, their own assumptions were quite pessimistic, right? What was it, 5% unemployment rate or something like that for the last year and a half? So
Yeah.
they're playing it safe, and they are over delivering, that's for sure.
Okay, Tevis, can you take over on this press release? I'm just going to plug some numbers.
Just plug the numbers during the call, no?
Yeah, but I would like to talk about, like, we have 45 minutes.
Sure.
Anyone knows anything about this possible new Fed chair, Kevin Warsh?
He's hawkish.
He's hawkish. Great stuff.
Well, he's more hawkish than Hassett, that's for sure.
So there might be a specific reason why he got chosen, because I mean, Trump doesn't like high rates, so I guess something needs to work there.
Yeah, I mean, I think the thought process right now is that Besant was the one that chose versus Trump. But yeah, that's why the market's reacting the way it is. Because if it was Hassett or even Rick Reader,
Reader.
From BlackRock.
then I think both of those guys are more dovish than Powell, but this guy is definitely hawkish.
And you still have a possible government shutdown.
I think that was averted.
Well, on Kalshi, I saw this morning it's still at 65%. Unless people like to lose money, I don't know.
Yeah, I think that's a lot higher than it should be, but yeah. I think that there's still a chance. Like if I was reading it correctly and it came in, last night, so we'll have to see. But that there was still something that needed to be done there. But like, yeah,
Tevis, you taking over here?
Yeah, sure.
I'm waiting for you.
Yeah. What do you got? Okay, sure. Here.
Oh, I'd go to the presentation. That's what I would, or sorry, the press release.
Sure. All right, let's run through this and let Tanner enter his numbers.
teamwork.
Yeah, is there anything you guys specifically want to jump into?
Yeah, the products is really interesting. Go down to the products highlight, because that's we're used to seeing a certain ratio of new members to products, and of course the thesis has been for a long time that we'll see an increased adoption. Just scroll up just slightly and stay on that for a second. We'll see increased adoption as they continue to offer more products, as they have more members as well, and as the value is just apparent. People oftentimes like to have many of the same things in the same ecosystem, myself included. This seems to be continued validation of that thesis. So they added a record 1.0 million new members. These are new, so this is not net. You'll see a different number on the slide as a result. So keep that in mind. But leading to a 35% year-over-year increase, and then at 1.6 million, typically we would see like 1.5 if there's a million members added, and there's some that churned off as well. That's a very healthy. That might be like the largest spread since I've been an investor. In gains in new products versus new members since May 2023. So really, really good. That's a standout number to me. What do you guys think is maybe driving the new product adoption there, like in the short term? Like they mentioned a few things, but it's
I think low barrier to entry products, man. I think there was upgrades to Relay in December, right? They launched the new credit cards. Of course, crypto contributes to that as well. So the more products that they have, just from a sheer number perspective, that are low barrier to entry products, then they're going to increase that cross buy. So I put it here: cross buy reached 40%, 7 points higher than a year ago quarter, demonstrating the one-stop shop model.
Have they broken that out before?
I think they have talked about it. I don't know if there's an actual diagram on the cross.
Yeah. I mean, I like extra information, and I don't remember seeing that. I remember it being mentioned a couple of times, but yeah, it's nice to have the visual there. Yeah, this is central to the thesis of SoFi. Is if it was just a lending platform, it's a really good one, but that's not the full thesis at all. So yeah.
By the way, guys, he's still not on CNBC. Stocks up 4.5%, 25.44. It's going to come down to the call, and then even then, whenever the market opens, that's a completely different situation than what we're seeing at the amount of volume that's coming in at 7:23 Eastern Standard Time. But
personal loan charge-offs down 57 basis points year over year. Very healthy. I mean, that's not just healthy, that's great.
Yeah, I found the originations was actually really interesting as well. Hold on, this is the slide that I want to.
Yeah, let's take a look at it.
Because they broke out originations for the LPB versus the rest, and look at the boost, man, in student loans and home loans for the fourth quarter, and then you also see the boost in personal loans, and they split it out between loan platform business in gray. And you can see the sort of year over year there from 1.1 to 3.6, and then their own personal loans in blue. But overall, pretty solid originations in the fourth quarter across the board, across all of their lines.
Yes, absolutely. And I can pull those up just so we can see the quarterly. Give me
more huge quarters for SoFi Money, SoFi Invest.
Yeah. Maybe we can jump into the product breakdown. Any thoughts on that, Neil? I saw you on mute.
No, I was just wondering if Tanner, if you have a slide that might show how many products per members or how many yeah.
Plugging right now, but I gotta.
So yeah, like Relay 6.6. Wow, it's a big jump, man.
Crypto 63,400 accounts for crypto. Crypto's a new product line.
That would be it. Well, that would be a help towards that product number. Yeah.
So they say product counts for crypto in the fourth quarter 25 reflect activity from the launch on December 22nd through December 31st. Wow, that is just a week of crypto, and therefore not representative of full quarter performance. So keep in mind, guys, the 63,000 products is just for a week.
Yeah. Wow.
Yeah, there's some good incentives there, but yeah, they have a. It'll be interesting to see how the Clarity Act works out. But I mean, they're a bank; they're issuing stablecoin. They're not worried about this, so lots of advantages for them.
I'm going to assume that crypto falls under financial services as I add this to the other product lines, not just lending.
Correct.
Okay.
Annualized revenue per product is up 29% year over year. Not bad at all. $104.
Stock's going up 4.8% right now.
Revenue per product? Yeah.
Annualized revenue per product, yes.
Yeah, credit card performance really helps with that instead of it being death to that number.
Dude, I have so much weight off my shoulders from, guidance not being like the 30% growth. I was so worried about them saying something like 26, 28% growth, something like this, and then upping it each and every quarter. The fact that we at least got a 30 handle just at least allows them to say, you can call us a bank, you can put us in these sort of categories, but the number of companies that you can put us with that are expected to have adjusted EBITDA of 34%, and that will be better than expected with 30% growth. So they're immediately shooting for essentially a 64%. Or sorry, no. Yeah. I'm correcting myself and then denying myself. But a 64%. What do you call it? Rule of 40. Chris said he's on in just a second, but I'm seeing Starbucks right now. But
I love the fact that we have and just communicating these things.
Yeah.
Well, he's just saying what's available.
No, exactly. It's
so helpful,
public, but it just helps navigate.
Okay, quick thing. The thing I just mentioned, the annualized revenue per product is up 29% year over year, but flat quarter over quarter. So 2 quarters in a row, $104. In Q2, that was $98, I think. So
sorry, could you say that again?
The annualized revenue per product is at $104, same as last quarter, but still up 29% year over year.
Got you. Products per member increased to 1.477, so it increased by 0.09. I'm going to remove crypto here for a sec just to see how that influenced it. No, it's still up. It's still up by 0.005, which is fantastic. One of the largest quarter over quarter changes that we've had since the only time that's been better was last quarter.
This is interesting. So yeah, no meaningful changes to macroeconomic environment.
Wait. He's on CNBC.
All right, put up.
$1.01 billion versus the $985 million that the street was looking for. And
that volume's on them, by the way.
Noto. He is SoFi's CEO. Anthony, just tell us a little bit about the quarter. Numbers did come in a little better than had been expected. Why?
Sure. It ended an incredible year for SoFi. In the quarter, we had 37% revenue growth, 35% member growth, and 37% product growth, with really strong margins at 29%, and our EBITDA increased 60% year over year. Overall, we've been driving more than 30% revenue growth each quarter throughout the year. And as we go into 2026, things look incredibly strong and guided the first quarter to 35% year-over-year revenue growth and the full year at 30%. It really reflects the innovation that we're driving, the number of new products that we're building, as well as the increased awareness through our branding efforts. So all cylinders are hitting very strongly right now, and it's coming out with these results. It's really unprecedented, 37% revenue growth with 29% margins.
Yeah, Anthony, over the last year, your stock has performed remarkably well. It's up by about 55% over the last year. But if you look at it for the year to date, it's down. And there are several reasons for that. The first would be that capital raise that you all did in December, $1.5 billion. People are a little worried about dilution there. Another issue is just you guys have all these new offerings that you mentioned. Cryptocurrency has been under some pressure, and that has weighed on everybody who is making some of those offerings. But why don't we go through those one by one? First of all, the capital raise that you did, what are you doing with the money? What do you say back to any concerns on Wall Street about that?
Sure, it was really an opportunistic capital raise. We saw an opportunity to add to our balance sheet. Many people are looking at it in different lenses, but the way we look at it is it was accretive to our tangible book value. Our tangible book value increased by more than $2 per share to $7 overall. And the capital that we put on the balance sheet gives us great flexibility to either drive faster growth in 2026. If we find something from an M&A perspective that would fortify our competitive position, we could do that. We can also reduce debt and improve our cost of funding. So, accretive to tangible book value is a really great measurement for us to evaluate these capital raises by. There's no specific use, but it gives us a lot of optionality. One of the things that happened in the quarter was we had over 40% loan origination growth, but only 15% actual lending revenue growth because we've built this business called the loan platform business where we use our technology and our marketing capabilities and our underwriting capabilities and our balance sheet to produce loans for other people. Now we have so much capital on our balance sheet, we're at like 2x our statutory required leverage ratios. We have an optionality to grow the business in any direction as it relates to lending that we'd like, in addition to doing things like M&A or reducing our cost of debt.
We should point out that the shares are up by about 5.3% this morning on some of this news too. But let's talk about what's been happening with crypto, some of the pressure that have been on those cryptocurrencies and what that has meant just in terms of how you see things, what that means for the new products that you're offering.
Sure. We used to offer buy, sell, and hold crypto tokens that we had to exit 2 years ago based on guidance from the OCC. With the new administration and new leadership of the OCC in April of 2025, we were given permissibility to operate in crypto, and we've run as fast as we possibly could to get to market. We launched SoFi Pay, which is using Bitcoin to send money internationally. We launched SoFi Buy, Sell, and Hold in December, and then SoFi USD stablecoin. It's very early days, but the reaction from our members in these offerings has been quite positive. We feel like we're just getting started. We're benefiting from two technology super cycles. One is crypto and blockchain, and the second is AI. And it's unique that one company could benefit from both of those. So there's much more horizon for what we'll do from an innovation standpoint. But it's only been about a month since we've entered the two new areas that we're in. And I think the price of crypto has an impact on some companies, but we have very little revenue from it today. So it's not really a direct impact there. I think what you've seen in the sector since the beginning of the year is uncertainty around interest rates and the naming of a new Fed chair. I think will start to put some stability under the market as it relates to interest rates. We'll have to see how things transition with the confirmation with the Senate and then what ultimately the new secretary decides to do.
What do you think of Kevin Warsh being named as the president's nominee to head the Fed?
Yeah, we at SoFi and I personally are huge fans of Kevin. We think it's a great choice and really look for the leadership change and a new mindset as it relates to the role of the Fed.
And very quickly, Anthony, we have spoken with a lot of the big bank CEOs about what it would mean if the president's proposal to put a 10% cap on credit cards actually went through. It's an issue for you too. What would it mean if that cap went through for 1 year?
Sure. The revenue that we generate from credit card is quite small today. It's almost immaterial relative to the over $1 billion of revenue that we're producing per quarter now and over $3.5 billion for the year. We have a product called personal loans. And our average loan size for a personal loan is about $30,000. And our average interest rate on personal loans is around 12%. It's about half the average interest rate of a credit card. So the demand that we get for our personal loans is actually people refinancing their credit card into lower cost debt that amortizes down. The credit card industry has a lot of different players, but ultimately you make money in that business because people keep the revolving balances out and you can charge 25% interest. That is not a good product. That is not getting your money right. Using a SoFi personal loan to cut that rate from 25% to 12% and having it amortized down so you get out of debt is a much better value proposition. So if there is a cap on credit cards, we think the demand for a personal loan will actually go up, and people will use that as a first product as opposed to refinancing their credit card debt in the first place.
Anthony Noto, great to see you this morning, and we appreciate your time.
Becky, thank you very much.
Seems Becky hasn't even had her coffee yet. Holy.
Becky, a
Good
little
question.
slow today?
Yeah. Becky was like not wanting to be there.
Well, so like in fairness, we talked about this last night too, Tanner. Like this week has had just a fire hydrant of like news and events. It feels like a month. And so it wears anybody out. Like it's exciting, but boy. Yeah, really good questions there. The one that, unless I missed it, I don't think that they were asked about dilution, which I think they would have had the same answer. They asked about the past dilution. No.
Oh, yeah. Future
Not-
dilution.
Yeah, like, are you going to dilute right after this, Noto? They're not.
I mean, I like he kept the door open for acquisition. He said, "Hey, look, it's just good competitive position to be in. If we want to make an acquisition in 26, we can do that." So I think that's what I mean. A lot of the people watching, want to hear because it's more sexy than saying, "Oh, well, tangible book, value is going up." But ultimately, like we said in December, like it's a trusting management to do what's best from an ROI perspective so that it's accretive.
Yeah, I mean, they're not just going to keep diluting just to put cash on the balance sheet. There's no reason for that. So if they're going to grow their loan book, great. If they're going to acquire something, that could be good too. But stock's up 5.5%. Just going around the clock. Be honest here, okay? This is all recorded. Who said pump? Who said dump? Which one?
I said pump.
Tevis?
I said pump in the morning and fade to the day.
Okay, all right.
We'll still see.
I
Neil?
have 70% pump in the chat for me, so
I'm not talking about in the chat. I said, what was your answer?
I don't know. What did I say? Did I say we're going to dump?
I don't
you
know.
Said we're
I don't
going to
know.
zero. No, I'm just kidding.
Yeah.
I think you kind of echoed Tevis's sentiment that it might be a repetition of a similar pattern, and that macro might.
I mean,
Macro is
when,
wild.
when the market opens, anything can happen. But I mean,
Yes.
so far numbers look very good, and I think it helps that the stock was pushed down a little bit over the past week or two. Even if we were closer to $30, I think the stock should have gone up. But
Yeah.
I'm holding the
Good
Bears'
numbers.
feet to the fire.
I think the call is also going to be really impactful for this one, especially because they're going to get questions around guidance and their underlying assumptions with guidance and so on. So I'm expecting some price movement upwards during the call Q&A.
Okay. Anything else on the did we look through all the quotes and everything that Anthony had said?
I think we got all of them. Yeah. Yeah. So, what are you wanting to hear most on the call? Like specific information. For me, it's I'd like to know a little bit more on the tech platform and expectations. It's since that includes Chime's number, that's I think lower than any of us were expecting. And it's interesting because Chime said that they would maintain contractual obligations through the first quarter. But yeah, it's odd.
Well, interestingly enough, on the tech platform, Roy, what they've said in the past is to expect an acceleration in Q1 of 26. And guess
Yes.
what? Starting, right now we are in Q1 of 26. So we should be expecting a big jump, essentially, or at least a turn and trend this quarter. Hopefully they would talk about that.
probably also because we are now so low anyways, so it's like quite an easier way to go up. But yeah, I agree. I would love actually to hear maybe more about SoFi Pay, SoFi USD. They did previously say that, I mean, SoFi Invest is under monetized, so traction on all of that would be great. Unaided brand awareness did increase a tiny bit, but I think it's still just under 10% right now.
Yeah, about 9.6%.
Yeah, so still some ways to go. That's the thing. There's just so much growth and opportunity left. I do wonder if they were to acquire a company, what would they acquire now? Because what do they actually need is the question.
Brokerage.
Yeah, I was gonna say some crypto company.
Yeah. I honestly, I've been hearing a lot. Like, we've heard Anthony Noto say that they were looking for a crypto company. He's made some comments about an AI business. But I've been hearing these small comments talking about how they might be looking at a brokerage and really get into self-directed investing, not just with SoFi Invest, but a more serious, you know.
So eToro?
Who knows?
Yeah, that would, like, if they really want to do international expansion, I think Noto's vision does take SoFi, at least with some of their products internationally, more than they are. That would be a really good way to do it.
eToro still doesn't have options after so many years of people asking, but
I did not expect eToro to be so small. 2.5 billion for eToro.
It has been beaten up. Tanner, if guys are interested in that, Tanner did a good video on it too. Devin Ryan's been covering it and pounding the table, and it's definitely undervalued. I think it's lower quality than some names that we follow, but it's
am I the only one that uses it?
Okay, wait. So Neil, I will not keep on the eToro talk for too long, but
go ahead.
All I've heard is bad commentary about the user experience and that fees are high. Can you give me some user experience?
The fees are okay. User experience, it's a very, very easy platform to use. So I don't know who complains about it. It's very easy to use. It's very simple, unless you're doing some portfolio copy trading or whatever. Just to buy and sell, it's very easy. Fees wise, they did implement, I think it was a year ago or something like that, like a flat $1 fee when you do buy a stock. It doesn't matter the size, and then you have the usual spread. Okay, it happens everywhere. It's like it's no commission, but okay, you are anyways paying a small price to buy. But I don't think it's like the most expensive platform out there at all. And again, they don't have options, so it's crypto and stocks. That's basically what you have. Maybe it's expensive if you're buying
well, they have
CDFs
commodities
or
and
things
stuff
like that.
too, right?
Yeah. But
sorry. I think that there's a better acquisition target for them. If they want to go brokerage route, it's public, just like easy. The culture fits very well. They have a very good AI product. Alpha is really, really good. Platform is really nice. They do crypto trading, and they do a lot of the different things that Noto has talked about in the Invest platform as well over the last few years. Same mentality as well. Like even as far as like people getting their money right, they've criticized predictions market. Like I don't know about like the financials and everything. It is a private company, but in talking to Life Abram, like he would fit very well in SoFi's ecosystem. So hey, SoFi guys, if you're looking, have a conversation with them. So
how big is it?
They're valued currently around 983 million. They peaked at 1.2 billion when they raised their D round in 2021.
I thought they were like a $5 or $6 billion business.
They raised a D3 round in March of 2025, 25 million at 983 million valuation.
No.
So it's possible.
It's only available in the US, right? Or maybe Canada as well, or?
No, not Canada.
So just US. Okay, so eToro gives you a bit more than that, but I guess cheaper is public.
Yeah. 75 countries in eToro. Dude, do you know this, Tevis? They ended up buying Bitcoin on their balance sheet. What price do you think eToro ended up buying Bitcoin on their balance sheet? What price do you think their initial entry price was?
This year? They started a position?
No, I'm not going to give that away. That would be too...
No, it was a long time ago.
I mean, since you're bringing it up, but yeah, I'd probably say $500.
It was $5.
That's crazy.
Their initial purchase price of Bitcoin was $5, and Vitalik Buterin came in to interview Yoni back whenever he worked at like Bitcoin Magazine to ask him about why they were interested in Bitcoin. They wrote the initial white paper on tokenization of equities.
Wow, that's crazy.
They are crypto fanatics.
But you see, the problem is the lack of execution. Because if you compare it to a Robinhood, I mean, Robinhood has
7% right now.
It's pumping right now.
Yeah.
Pump. Okay.
7:45 when normal people wake up, they're like, "Oh, this thing's up."
Too many
Dude.
people that saw this name just going down for 3 months, thinking that that's just because that has created a trend that has to continue to happen. That does not need to happen.
No, not at all.
And if you look at the financials, like okay, they didn't hit the 50% that I thought that they would. They lended a little bit more conservatively. It does take a while to actually monetize off of that, but 40% plus growth on a consistent basis on a company this size that is S&P 500 eligible, that gets people's attention, and it's not just top line growth either. So great company, and it is undervalued.
Yeah. Yeah. It was one of their, I think you could say, like, slower origination quarter over quarter changes than they usually have, which does make you think, what are they doing with all this cash? 14 minutes till the call. This is going to be pretty exciting.
So on the guidance, Tanner chimed in there, and I mentioned too, like Tevis and Neil, like how sandbagged do you think the guidance is? Because they did raise, and probably a little bit more than would be a typical SoFi raise. Is that just same conservative number, as far as sandbagging, but they're just like, hey, macro is so good, and we know what we're doing. Like, we're still being very conservative, but it's going to be amazing. Or like, where do you think they actually come with that 60 to 80 range?
I think it's fairly conservative from a guidance perspective, but at the same time, they don't even know like what the final decision is going to be for the Fed chair. Like I think macro environment can fluctuate if we get more dovish. I mean, if Kevin doesn't go through or whatever the case may be, like there's an unknown there around the macro, and so that is underpinning their guidance. And so I understand them to be more conservative, but it did feel conservative to me. I think they're still continuing their strategy of just, sandbagging and then beating and raising. Neil?
I mean, are we expecting rates to go up this year? Probably not. So it's either going to be flat. I think we're still going to get a cut. So even 80 cents, I'll be very happy with 80 cents. If they can do more than 80 cents, that's even better. But they are also entering now another growth stage of the company. So I guess they are putting the bar a bit lower, although it's higher than what they previously did. So I'm still expecting the usual beat and raise unless something drastically changes with the economy and they have to adjust. But I just don't see that happening anytime soon. So yeah, I still expect beats and raise for the next couple of quarters.
Let me respond to that, why the rates are important, because I don't think anybody's expecting that rates are going to get raised, but depending on the number of cuts we get in 26, which is going to be depending on who passes through on the Fed, it's going to matter for the total addressable market from an originations perspective for home and student. And if 26 is the year that they expand loan platform business outside of personal loans, then all of a sudden that's going to be really relevant to how their revenue profile looks, right? So there's assumptions baked in there, but Chris Lapointe was talking about this on a fireside saying, every, I think 25 or 50 bips that it follows, their total addressable market for student loans goes up like 50%.
Yeah.
But what are the expectations for cuts this year? Only one, right? One or two? One, I think.
I think you could say 1.5.
So well, we don't know SoFi's, but CME Fed Watch, and it'll be interesting to see how this moves today with the Kevin Warsh name that's out there. We're currently at 350 to 375. Consensus is all over the place, but 33.4%, the highest number has 2 rate cuts. So 22% have 3, 25% have 1. So wouldn't be surprised if SoFi's own expectations is, again, like 1.5. Probably it'll be 2, but we'll have to see.
Okay, let's. I want to quickly switch the topic really quick. One of the things that I find is interesting I'm not going to bring up a specific stock or whatever, but obviously we've been talking about SoFi for some time. So there's a tendency whenever looking at markets that people always try to find the next new name, right? There's been a couple names that have been floated that over time end up triple beating, raising guidance over time. And that's really exciting for markets because they're going to continue to do well and the numbers look great. But that's exactly what SoFi is doing. And this might be an old name to retail, but whenever you're thinking about compounding wealth, it doesn't matter how in vogue a name is or something like this. It matters that, they continue to make more money and profit over time. Whenever you talk about SoFi here, and we take a look at 2026, the consensus still for full year of 2026 is at 58 cents. Even SoFi, the king of, setting expectations low, is putting it at least higher than Wall Street expectations. Some people's range, by the way, there's somebody is saying that we're going to see 47 cents for next year, like below their midpoint guidance. But then even out into 2027 and 2028, now they're guiding for 30+% growths in revenue and even higher rates in EPS. So all of these ranges are going to need to change tomorrow.
Yeah. So just hover on that for a second. 47 cents to 67 cents of EPS. SoFi's own numbers is 60 cents to 80 cents. That just was announced today. So what that's going to do is later today, all of these analysts are going to be forced to raise their estimates to at least be in line with what SoFi themselves is saying.
Well, they don't need to. You see the range, 47 cents. They weren't even listening to the 55 to 80.
They'll look stupid if they don't.
Yeah. Even what typically happens with numbers like this, and it's not just guidance, but it's actually numbers that are backing it up, is even those that are bearish and pessimistic, they'll raise by $1 or $2 their price targets just because they don't mind being bearish, but they hate to be, with a few exceptions, like ridiculous outliers. Now, sometimes there's a Gordon Johnson that does it for attention. There's one on every ticker. But outside of that,
what's the name of the? What's his name? Come on,
Cavarini, Bologna.
No. Cavarini's gone.
Yeah, he is.
Yeah, Bologna. Yeah,
Mr. Bologna. Yeah.
Bologna is our Gordon Johnson. We're up 8%.
He's not even that bad relative to, but yeah, there's always going to be one in each ticker. And there's also some outliers on the top end too, but usually they like to be kind of in a clumped range around this. I'm just really glad we talked about this too yesterday briefly, Tanner, that if SoFi came out with such conservative guidance that they look like bears on their own stock relative to where analysts are, that wouldn't have been good either. I didn't expect that, but yeah, good guidance.
Yeah. But that's what it felt like going from 2024 to 2025. It felt like we were being let down.
Yeah.
This did not feel like that.
No.
So let's see here. Adjusted
Call is coming up in less than 10 minutes, guys, in about 6 minutes.
Yeah, I'll have it.
So we're looking at 2028, close to $9 billion in revenue and 1.7 or so in EPS. Is that higher than what some analysts are expecting? I don't know if we have estimates for 2028, but at least now we know where we should be going. I don't know if it's higher or lower or in line.
Here, let's see.
At least in fiscal AI, there's no 2028 there yet.
I'll check some other ones as well.
In the meantime, I'll finish my thoughts on this eToro Robinhood thing because that's what people wanted to hear. I'm jealous that I don't have access to. I have Robinhood, but just the tokenized stuff in Europe. But if Robinhood was available in Europe, just like in the US, it would probably be my primary place to invest. eToro might have been early and first in this whole social investing, which congrats to them.
Yeah.
But the execution should have been much better, and this would have been like a $50 billion company already right now, because they are available in way more places than Robinhood. They still don't have options, which is something that users and even people inside the company that I know have been asking for many years. And it's not even something that's on the roadmap in the short term, from what I've been hearing, which is mind-boggling, which is a shame. Maybe it is an acquisition target, and maybe someone else could do something better with them.
Yeah, maybe. Yeah. I took a look. This is dated by like 6 months ago when we were looking at Webull and then in it, and then like, I don't know about the leadership we got out. And then I looked at eToro just briefly and came away with the same conclusion, Nil. I don't think I obviously I can't put my fingers on the actual product, but my assessment was Robinhood is ridiculously high quality, and I don't know that there's anybody that comes close. I mean, like that, it's a public company that you could invest in. Not talking about public itself, like it's pretty good. But
maybe interactive brokerage is not bad.
Active brokerage, and then so like qualitatively, it's still worth something. It's still very undervalued, I think, but yeah, quality is not as high as you would expect. So,
guys, I ended up looking out to 2030 for Wall Street expectations. We have the call here in a couple minutes, but let's just I want to I apologize to cancel the eToro talk, but we got a couple minutes. The revenue expectations to 2028 is currently sitting at 5.6 billion, 2029 6 billion, 2030 $6.7 billion in revenue. Okay. What SoFi is essentially calling for is we're going to beat those expectations in 2027 at 6.1 billion, and at 2028 we're going to have $8 billion in annualized revenue. This is leagues higher than what Wall Street is putting at their 2030 targets. Leagues. Like Devin Ryan, great analyst, extremely competent. He's super wrong on his 2028 targets. You know, Anthony Noto essentially just put the nail in the coffin for long-term shareholders, saying that they won't be able to compound at this rate going forward. They're saying no, for 3 more years we're going to be putting up earnings per share 38 to 42%. Let's imagine that this company's multiple stays still, and like we're looking at this company at a price to earnings, but they're growing EPS at 38 to 42% growth. That's not assuming that they end up beating and raising that number. What happens to the stock price compounding over that period?
yeah,
You'd have to start adjusting for 40%. Now, maybe, PE ends up coming down a bit to a more reasonable level. We still end up growing at 42+% rates. The stock might end up compounding at 30%. You're destroying the market at that rate, and you're still getting a cheaper stock every year. Like, we're talking about a compounder. This 2028 guidance call was phenomenal. Now, I know that there are some SoFi people that watch. Please, guys, do an investor day. I would love to hear more about how you guys are going after your clientele. Who's your prime suspect or prime client, and how they end up spending, depositing, more user activity on the platform as time goes on. Because my assumption is that cohorts that have been on there for years end up spending more, saving more, have multiple loan products. But if you tell that to the market, that's probably going to be, lead to an even higher multiple than what we're seeing right now. Can someone send me the link directly to the web thing? The website is bugging out for me.
Yeah, let me see if I can get it.
while you're getting that pulled up, like that's the one thing about their very conservative guidance. Their long history of beats and raises is, how can you look at that? Like, the only thing that they've given us that was like really quite wrong was their expectations of guidance regarding the tech platform. That's old news at this point. As far as the overall picture of their company, they've usually beaten by a good bit over their own expectations or the guidance that they put out there. So it still puzzles me, like, when you have that long history and track record, same management team, same leadership, same company, and they're saying, hey, we're going to put out these amazing numbers, and they're like, nah, you're not going to do. They will. Like, I don't know any other way to put it. So yeah, great long-term hold for me.
If anyone was sick of my channel and the amount of SoFi content that I put out, and you want me to diversify, too bad. Okay. Like, it's so extremely hard to find these types of compounders, and you don't need to find a new name constantly. I'm going to buy SoFi stock right now. I like, whenever you find a great winner, sometimes it's good just to double down and triple down on those names. As Warren Buffett says, you only need a few winners over your lifetime. I believe SoFi is definitely one of those. Call starting. Here you go.
I'd like to welcome everyone to the SoFi Technologies fourth quarter and full year 2025 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's fourth quarter and full year 2025 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the fourth quarter and full year 2025 versus the fourth quarter and full year 2024. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and a subsequent 10-K filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-K. Any forward-looking statements that we may make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. 2025 was a tremendous year on all fronts. Our member focus drove an unprecedented level of innovation across our business and led to the strongest financial performance in the history of our company. As we begin 2026, we're positioned for another year of unprecedented results, and I could not be more excited. We come into the year with a differentiated one-stop shop model with a full suite of products that allow members to borrow, save, spend, invest, and protect better. A demonstrated track record of driving durable growth through continuous innovation, resulting in compound annual growth of nearly 50% from $240 million in 2018 to $3.6 billion in 2025. A scaled member base of 13.7 million members, more than 20 times larger than the 650,000 members we had in 2018, and our highest brand awareness ever at nearly 10% versus roughly 2% in 2018. Despite that unprecedented growth, we still have massive addressable markets across our existing businesses and huge opportunities for growth in newer areas like crypto, AI, and business banking. And finally, we have a fortress balance sheet, which we further strengthened through $3.2 billion in new capital, increasing our tangible book value by $2 per share to $7 per share, giving us a broad range of optionality. This gives me great confidence that we will continue to drive durable, compounding growth for years to come, resulting in superior financial returns. I will discuss some of what we've planned for the year ahead in a moment, but first, let me begin with our key results for the fourth quarter. Starting with the drivers of our durable growth. We added a record 1 million new members in Q4, increasing total members by 35% year over year to 13.7 million SoFi members. This was our first time adding over 1 million members in a single quarter. We also added a record 1.6 million new products in Q4, increasing total products by 37% year over year. We now have over 20 million products. Cross-buy continues at an exceptional pace, with 40% of new products opened by existing SoFi members. Over the past year, our cross-buy rate has increased by 7 percentage points,
This clearly demonstrates the effectiveness of our one-stop shop strategy and our ability to build deeper, multi-product relationships with members. And that is before we fully leverage new technologies like artificial intelligence. Our strong member and product growth powered our revenue growth in the fourth quarter. Adjusted net revenue was a record at over $1 billion, up 37% year over year, marking our first billion-dollar quarter. Together, financial services and our technology platform generated revenue of $579 million, an increase of 61% year over year, and representing 57% of total revenue. In our lending segment, adjusted net revenue grew 15% year over year to $486 million. This was driven by strong originations in the segment of $6.8 billion, a 13% increase from the prior year. Combined with the very strong loan platform business originations of $3.7 billion, total originations reached a record of $10.5 billion for the fourth quarter. This is our first quarter originating over $10 billion in loans, demonstrating our ability to originate high-quality loans at scale. In fact, through all of 2025, we originated over $36 billion of loans. I am also proud to report that total fee-based revenue across our business was a quarterly record at $443 million, up more than 50% from the prior year, driven by strong performance from our loan platform business, referral fees, interchange revenue, and brokerage fee revenue. On an annualized basis, we are now generating nearly $1.8 billion of fee-based revenue, up from less than $1.2 billion in the fourth quarter of 2024. This reflects our deliberate diversification towards more capital-light revenue streams. In addition to delivering durable growth, we delivered strong returns and profitability. In the fourth quarter, adjusted EBITDA was a record at $318 million, up 60% year over year. Our adjusted EBITDA margin for the quarter was 31%. This is above our original goal of long-term margins of 30% set when we went public. Our incremental EBITDA margin was 44% as we continue to balance reinvesting in the business to drive long-term growth and profitability. Net income in the quarter was $174 million at a margin of 17%. Earnings per share were 13 cents. Finally, our tangible book value ended the year at $8.9 billion. In 2025, we grew tangible book value by over $4 billion and $2.54 per share. Our diversified business is uniquely built to deliver a winning combination of growth and returns. In the fourth quarter, we achieved a Rule of 40 score of 68%, once again demonstrating the strength of our model and our solid execution. The consistency with which we've exceeded the Rule of 40 continues to put us in rarefied air among fintechs and technology companies more broadly. Despite these exceptionally strong results, I know that we are just getting started. We are still just scratching the surface of the opportunity that exists across each of our existing products and the newer areas like crypto. Given these dynamics, I've never been more optimistic about our prospects than I am today. This is why we will continue to invest heavily to make our existing products even better by providing the best speed, selection, and experience, to build new products to help our members get their money right, and to further strengthen our trusted brand name. Our investments will power our durable compounding growth and drive stronger returns as we continue to scale. Let me now spend a moment discussing our brand building efforts, which are key to driving new members to SoFi, feeding our productivity loop and growth. In 2025, we significantly increased our brand strength and stature through our first ever music partnerships, including becoming the presenting partner of the CMA Fest and partnering with country music star Kelsea Ballerini, and by expanding our sports partnerships. More recently, we signed reigning NFL MVP Josh Allen to Team SoFi. Josh has been instrumental in showcasing the most valuable product in financial services in SoFi Plus. This partnership included ads across some of the most watched NFL games of the season and has continued through the existing postseason playoffs. So far, this has been one of our most successful campaigns ever, more than doubling the effectiveness of our advertising in the target market. This year, we also kicked off season 2 of TGL presented by SoFi, with exciting play from the biggest names in golf. So far, the season off to a great start, building on the momentum from last year with viewing audiences up 22% versus a year ago in the first 5 matches. And later this year, the World Cup will be coming to SoFi Stadium in Los Angeles, allowing fans worldwide to get a glimpse of the nation's most advanced stadium and the most ambitious stage in sports and entertainment. Our marketing efforts continue to have a strong effect, driving unaided brand awareness to an all-time high of 9.6% during the quarter. That's up 250 basis points from the fourth quarter of 2024, a 33% improvement. Turning now to our product innovation across our business. At SoFi, we are one team united under a common purpose of helping people achieve financial independence to realize their ambitions. We are passionate about meeting our members' needs, driving us to work harder and innovate more rapidly to bring them the best products and services in the market. We call this the SoFi Way. Guided by the SoFi Way with a differentiated business model and capabilities, we are uniquely positioned to benefit from both the crypto and AI technology supercycles taking place. Only SoFi has the strength and stability that comes with being a national bank, a tech-driven culture with a track record of innovating in the financial services industry, and a large and growing member base that embraces innovation. A full set of products that allow us to leverage crypto and blockchain technology in a number of innovative ways, and a technology platform that allows us to innovate more rapidly and serves as a channel to support business clients. Since March, when the OCC made crypto permissible for national banks, we've moved with urgency to bring new products to our members. In October, we enhanced our unprecedented money movement offering with the launch of SoFi Pay, our first payment product that leverages blockchain technology to provide fast, seamless, low-cost, and safe international payments. We've already expanded SoFi Pay to include over 30 countries, including Mexico, India, the Philippines, Brazil, and much of Europe. SoFi Pay is available to all members right in their integrated SoFi app, making money movement easier than ever. In November, we announced SoFi Crypto, once again giving members the ability to invest in dozens of tokens directly in our SoFi app. As the first nationally chartered bank to launch crypto trading for consumers, our members can instantly buy cryptocurrencies from their FDIC-insured deposit account, which is a very meaningful difference. At other providers, a customer's funds sit uninsured, earning no interest as they wait to fund digital asset purchases. At SoFi, those funds sit in a SoFi money account, protected with insurance and earning up to 4% interest. In December, we took an even bigger step forward through the launch of our own stablecoin, SoFi USD. This launch made us the first national bank to issue a stablecoin on public permissionless blockchain. Once again, this is a meaningful step forward in differentiation versus the landscape. For every SoFi USD outstanding, we will have $1 of cash in our Fed master account, which means there is no credit, liquidity, or duration risk, and we will share economics with partners for their marketing and distribution services. SoFi USD will be a game changer for our business as it enables us to be an infrastructure provider for banks, fintechs, and enterprise platforms, positioning us at the center of the crypto ecosystem. As you can see, we're moving quickly, but we have a lot more to do to accomplish our ambitious plans over the near and medium-term horizons. This year, we will leverage SoFi USD to power SoFi Pay, and we'll continue to add more countries to the offering. Over the medium term, we plan to offer a SoFi Pay experience to people outside the United States, allowing them to receive, send, hold, and spend money anywhere, all supported by SoFi USD. This initiative could serve as a launching point to build our brand in a more global way. In 2026 and beyond, we will look to offer additional crypto products and services, including secured lending by cryptocurrencies, which will give members better rates on their loans, institutional trading, and correspondent payments and settlement via stablecoins. For members that hold SoFi USD, we will look for innovative ways to provide them with benefits such as interest or other perks. Beyond our member-facing initiatives, we are hard at work building our business banking offering, which will begin to launch in 2026. Our ambition is to be the bank for businesses and other financial institutions that want to transact in both fiat and cryptocurrencies, filling a critical gap that has existed in the market. Leveraging our tech platform capabilities and SoFi USD, over time, we will build an offering that includes institutional crypto trading, making us the first national licensed bank to offer this service, stablecoin as a service, crypto card issuing, digital asset custody and infrastructure services, and the ability to interchange fiat and digital assets in real time through our SoFi Exchange network, as well as the ability to settle transactions 24/7 on a virtual ledger. We have brought on significant expertise from the crypto and banking industries, and I couldn't be more excited to see this business take shape in the coming years. Turning now to SoFi Smart Card, which we launched in the fourth quarter. This new all-in-one card and account allows members to earn significant rewards and an industry-leading APY while also growing their credit score. Here's how it works. Members can use their SoFi Smart Card to make purchases just like a typical debit or credit card. Purchase amounts are automatically set aside from the deposits in their SoFi account in real time. The balance can be paid in full each month via funds on hand or an alternative bank account or source of funds. And all the while, members earn unlimited 5% cash back rewards at grocery stores. We built and launched Smart Card in just 4.5 months with the help of our tech platform, a feat that would not have been possible had we relied on another party. This demonstrates once again how our tech platform gives us a greater ability to customize and launch financial services products faster than competition. Beyond helping drive innovation across SoFi's financial services products, we are excited to see renewed energy around innovation within financial services more broadly. This started to take shape in 2025 with big consumer brands like Southwest Airlines and United Airlines coming to us to help them launch new programs that drive greater loyalty and engagement from their customers. Now we are seeing strong interest from an even wider range of companies, including those based internationally, who see the highly supportive business environment in the US, particularly for crypto, and are interested in launching new products here. Our tech platform business is in a prime position to support these enterprise clients. Turning to Invest. 2025 was a blockbuster year for SoFi Invest, in which we significantly expanded our offering to give members the best selection, including investments that have been traditionally reserved for the ultra-wealthy. We gave members access to private companies, including SpaceX and Epic Games, access to invest in alternative investments through private market funds managed by Cashmere, Fundrise, and Liberty Street Advisors, access to invest in IPOs, including Klarna, Gemini, Figma, and StubHub. We launched Level 1 options and our own SoFi Agentic AI ETF. We made rolling over 401ks easier and more efficient, and we continue to make our user interface even more intuitive and engaging. This expanded offering helped drive a 2.2x year-over-year increase in their brokerage revenue, helping drive Invest closer to full profitability, which we expect to achieve this year. Turning now to our lending segment, which continues to drive strong revenues and allows us to support members at key points in their lives. We show up with a simple but differentiated message. We are here to help you get your money right. Our personal loan product does just that. With a SoFi personal loan, members can refinance absurdly expensive credit card debt held at other institutions so they can stop paying for other people's rewards and focus on their own financial well-being. For example, if a member is able to refinance $40,000 of debt on which they were paying 24% interest with a SoFi personal loan that has an interest rate that's 10 points lower, they can reduce their monthly payment by nearly $200, moving closer to becoming debt-free. If we translate that example across the more than 500,000 loans that were originated in 2025, you can see that we're having a massive impact on our members' lives. SoFi is the preeminent company offering personal loans, originating roughly 15% of total US prime volume. However, the opportunity remains massive as the real addressable market is the nearly $1 trillion of prime revolving credit card debt just sitting there waiting to be refinanced at up to half the rate. And that $1 trillion opportunity is before even considering the additional debt that is outside of our traditional credit box, but could be refinanced through our loan platform business. Our student loans are also designed to help our members get their money right. Here too, we have become the preeminent company for refinancing student debt, having a massive impact on our members' lives. We estimate that we will save our members over $400 million in interest expense just on the student loans we refinanced in 2025. Despite our strong market share in the student loan refinance market, we see continued opportunity for growth. We estimate the total market opportunity to be around $400 billion, which would increase by 25% if rates were to drop 50 basis points. In addition to refinance, we've launched new private in-school student loans options to help people finance their education, filling the gaps left by the federal graduate programs. These include medical, veterinary, dental, and STEM loans, with more coming soon. Turning now to home loans, where we had our best year of originations and where we are primed for an acceleration in growth when rates decline. In 2025, we originated $3.4 billion of total home loans, surpassing our prior record set in 2021 when the real estate market was at its height. In fact, in the fourth quarter, we originated home loans at an annualized pace of $4.5 billion, nearly 2x the pace of the prior year. And the opportunity for continued growth is massive. Within our own member base, about 90% of those that have home loans have them with other institutions. As rates come down and many of these members look to refinance, we'll be in a prime position to win that business. Additionally, as others within our 13.7 million strong member base look to purchase a home for the first time, we believe they will come to SoFi as a trusted partner. As you can see, 2025 was an incredible year by any measure, our best year ever. We leaned into what sets us apart, our unique one-stop shop strategy, our ability to innovate, and our relentless focus on helping members get their money right. Heading into 2026, we see a tremendous opportunity, and we continue to be energized by our values and the SoFi way to capture it. With that, let me now turn the call over to Chris to discuss our financial results for Q4 and 2025.
Thank you, Anthony. 2025 was an exceptional year. Adjusted net revenue for the year was a record at $3.6 billion, up 38% year-over-year. Adjusted EBITDA was also a record at $1.1 billion, up 58% year-over-year at a margin of 29%. This was our first time surpassing $1 billion of EBITDA. Net income was $481 million at a margin of 13%. Net income was up 2.1x, excluding one-time items in the prior year, and earnings per share was 39 cents. We finished the year strong with a great fourth quarter. In Q4, adjusted net revenue grew 37% year-over-year to a record $1.013 billion. Adjusted EBITDA was also a record at $318 million and a margin of 31%. Net income was $174 million at a margin of 17%, and earnings per share was 13 cents. This was our 9th consecutive profitable quarter. An important driver of our growth was the increased contribution from capital-light, non-lending, and fee-based revenue sources. Our financial services and tech platform businesses generated $579 million of revenue, up 61% year-over-year, and we also generated record fee-based revenue across all segments of $443 million, up 53% year-over-year. Turning now to our segment performance, starting with financial services. Financial services generated record revenue of over $1.5 billion in 2025, up 88% from the prior year. For the fourth quarter, net revenue was $457 million, up 78% year-over-year. Contribution profit was $231 million, up 2x from last year, and contribution margin was 51%, up from 45% last year. Net interest income for this segment was $208 million, up 30% year-over-year, which was primarily driven by growth in member deposits. Non-interest income grew 2.6x to $249 million for the quarter, which equates to nearly $1 billion in high-quality, fee-based income on an annualized basis. Importantly, improved monetization continues its strong contribution to revenue growth. Annualized financial services revenue per product was $104 in the fourth quarter. That's up from $81 in the fourth quarter of 2024, a year-over-year increase of 29%, and we see continued upside as newer products mature. The successful expansion of our loan platform business was one of our greatest achievements in 2025, further diversifying our revenue and making our growth more durable. We've built this business into a powerhouse. In Q4, our loan platform business generated $194 million in adjusted net revenue, an annualized pace of $775 million, which is nearly 3x higher than the same period last year. And as we head into 2026, we continue to see strong demand from both existing and new partners. Beyond our loan platform business revenue, we continue to see healthy growth in interchange, up 66% year-over-year, driven by close to $22 billion in total annualized spend in the quarter across money and credit card. Turning to our tech platform, which generated record revenue of over $450 million in 2025. For the fourth quarter, the tech platform business delivered net revenue of $122 million, up 19% year-over-year. Contribution profit was $48 million at a contribution margin of 39%. This includes the remaining revenue earned from a large client who fully transitioned off our platform prior to year-end. Turning to our lending segment. Lending generated record adjusted net revenue of over $1.8 billion in 2025, up 24% from the prior year. For the fourth quarter, adjusted net revenue was $486 million, up 15% from the same period last year. Contribution profit was $272 million, with a 54% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 29% year-over-year to $445 million. During the quarter, we had record total loan originations of $10.5 billion, up 46% year-over-year. Personal loan originations were a record at $7.5 billion, of which $3.7 billion was originated on behalf of third parties through LPB. In total, personal loan originations were up 43% year-over-year. Student loan originations were $1.9 billion, up 38% from the same period last year. Home loan originations were a record $1.1 billion, a year-over-year increase of nearly 2x. Capital markets activity was very strong in the fourth quarter. We sold and transferred through our loan platform business $4.5 billion of personal and home loans. In terms of personal loans, we closed $100 million of sales in whole loan form at a blended execution of 106.5%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we held on to the loans. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. In terms of home loan sales, we closed $692 million at a blended execution of 102.3%. In addition to our loan sales, we executed a $463 million securitization of loans originated through the loan platform business. This channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. The transaction priced at an industry-leading cost of funds level with a weighted average spread of 101 basis points. Turning to credit performance. Our credit remains strong, performing in line with expectations and driving attractive returns across all loan types. Our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 746, while our student loan borrowers have a weighted average income of $149,000 with a weighted average FICO score of 765. For personal loans, the annualized charge-off rate was 280 basis points, up 20 basis points from the third quarter. I would note that while this is up from last quarter, it is down slightly from the second quarter and down over 50 basis points from a year ago. In fact, this is our second-best quarter since 2022. Importantly, the increase in our balance sheet charge-off rate is driven by mix rather than credit deterioration. In Q4, as a result of increased LPB activity, we retained fewer new loans on the balance sheet. This naturally increases the average age or seasoning of our personal loan portfolio held on the balance sheet. Adjusting for this seasoning, underlying credit trends actually improved quarter-over-quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.4% versus 4.2% last quarter. The on-balance sheet 90-day delinquency rate was 52 basis points, up 9 basis points from last quarter, also driven by portfolio seasoning. I would note that the delinquency rate is down year-over-year. For student loans, the annualized charge-off rate was 76 basis points, up slightly from 69 basis points in the prior quarter, driven primarily by seasonality, as well as the impact of a student loan repurchase that began in Q1 2025 and concluded during the fourth quarter. The on-balance sheet 90-day delinquency rate was 14 basis points, consistent with the prior quarter. The data continues to support our 7 to 8% net cumulative loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originating from Q4 2022 to Q1 2025 have net cumulative losses of 4.55%, with 37% unpaid principal balance remaining. This is well below the 6.27% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by 8 basis points during the fourth quarter. In fact, this gap has widened in each of the past 6 quarters since we began measurement. Additionally, looking at our Q1 2020 through Q3 2025 originations, 60% of principal has already been paid down, with 6.8% in net cumulative losses. Therefore, the life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 40% of unpaid principal would need to be approximately 10%. This would be well above past levels at similar points of seasoning, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the fourth quarter, our personal loans were marked at 105.7%, down 8 basis points from the prior quarter. This included an increase in the annual default rate, which was primarily driven by loan vintage seasoning, not changes to the individual loan loss assumptions, partially offset by a lower benchmark rate. At the end of the fourth quarter, our student loans were marked at 105.6%, down 8 basis points from the prior quarter, driven by minor changes in the average coupon and annual default rate. Turning to our balance sheet. In December, we raised $1.5 billion of new capital in the form of common equity. This was our second opportunistic raise of 2025, giving us great flexibility to pursue organic and inorganic growth opportunities. It also allowed us to further improve our funding base. Over the past 2 quarters, we fully paid down our warehouse lines, reducing our funding costs by an estimated $110 million on an annualized basis, fully mitigating the bottom line impact of the additional shares. In the fourth quarter, including the $1.5 billion of new capital, total assets grew by $5.4 billion. This was driven by $3.1 billion of loan growth and approximately $1.7 billion of growth in cash, cash equivalents, and investment securities. Total company-wide cash at quarter end was $5.4 billion. On the liability side, total deposits grew by $4.6 billion to $37.5 billion, primarily driven by growth in member deposits. Our net interest margin was 5.72% for the quarter, down 12 basis points sequentially. This included a 30 basis point decrease in average asset yields as we saw a modest mix shift from personal loans to home and student loans, partially offset by a 15 basis point decrease in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 22.9% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Tangible book value grew $4 billion year over year to $8.9 billion, including the benefit from the new capital raised. And tangible book value per share at quarter end is $7.01, up from $4.47 a year ago, a 57% increase. Let me finish by providing our outlook for 2026 in the medium term, starting with the macro assumptions that underpin our financial guide. In line with market expectations, our 2026 assumptions are as follows. An interest rate outlook consistent with the Fed funds futures and 2 rate cuts to get us to a 3.0 to 3.25% exit rate in 2026. Real GDP growth of approximately 2.5% and an unemployment rate in the 4.5 to 5% range. Now for our specific guidance. For the full year 2026, we expect to increase total members by at least 30% year over year. We expect adjusted net revenue of approximately $4.655 billion, which equates to year-over-year growth of approximately 30%. We expect adjusted EBITDA of approximately $1.6 billion, which equates to an EBITDA margin of approximately 34%. We expect adjusted net income to be approximately $825 million, which equates to a margin of approximately 18%. We expect adjusted EPS to be approximately 60 cents per share. The guidance assumes a mid-teens tax rate, which we currently believe to be our effective tax rate in 2026. For the first quarter of 2026, we expect to deliver adjusted net revenue of approximately $1.04 billion, which is a 35% year-over-year increase compared to 33% in the same period last year. Adjusted EBITDA of approximately $300 million, which equates to a margin of 29% versus 27% in the same period last year. Adjusted net income of approximately $160 million, which equates to a margin of 15% versus 9% in the same period last year. And adjusted EPS of approximately 12 cents, 2 times the 6 cents delivered in the same period last year. It's important to note that each year we have seasonal payroll taxes during the first 2 quarters of the year, and we plan to accelerate marketing expenses in the first half of 2026 relative to Q4 2025. Overall, 2025 has been a remarkable year for SoFi. We are proud of the strong results we delivered and are excited to build on this momentum in the year ahead. Looking beyond 2026, given our differentiated model, the strength of our balance sheet, and the tremendous opportunities that exist across our business and in newer areas, we expect to deliver compounded annual adjusted net revenue growth of at least 30% from 2025 to 2028. Additionally, we expect to deliver compounded annual adjusted earnings per share growth of 38 to 42% from 2025 to 2028. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star and the number 1 on your telephone keypad. Please keep in mind we'll take only 1 question per person at a time, and please rejoin the queue for any additional questions. First question today comes from John Hecht at Jefferies. John, please go ahead. Your line is open.
Morning, guys. Congratulations on the good momentum. I guess my question is, you guys gave some good consolidated guidance. Maybe can you break some of those details out at the segment level?
Sure, I can take that one, John. So overall, like we've said in the past, given that we're right in the middle of 2 super cycles with blockchain and crypto and AI, and the fact that we have significant capital cushion in any scenario that we could have possibly imagined, that makes us extremely excited about the outlook for our business, both in the immediate and the longer term. In terms of our 2026 outlook, we expect continued very strong revenue growth of roughly 30% year over year. As it relates to the segments for financial services, we expect revenue growth of 40% or more. For lending, we expect revenue to grow approximately 23% year over year. And then for tech platform, normalized for the transition of a large client, we expect revenue growth of approximately 20%. And then for our corporate segment, revenue should generally be in line with what we saw in 2025 on a dollar basis. As we look forward out to the medium term, we're expecting at least 30% annual revenue growth compounded between 2025 and 2028, and 38 to 42% annual compounded EPS growth between 2025 and 2028. From a segment perspective, we expect to see continued momentum across all segments. And given the investments that we've made to date, we see the opportunity to accelerate growth in 2027 and 2028 across a number of products that are just starting to scale, including our crypto business, our brokerage business, home loans, and student loans, given the rate environment. So overall, really optimistic about the outlook, given everything ahead of it.
The next question comes from Andrew Jeffrey at William Blair. Andrew, please go ahead. Your line is open.
Hi, good morning. Great to see the momentum in the business. Anthony, you've talked about driving awareness, and I think you mentioned today on the call the opportunity for refinancing at $1 trillion. It looks like perhaps that messaging hit an inflection point this quarter, and you mentioned some of the celebrity partnerships. Can you elaborate a little bit on the acceleration in KPI growth, whether it's sustainable, whether you think this is sort of the tipping point at which consumers say, hey, look, this is simply a better answer than traditional banks? Can we sort of declare that we've reached that point in your business model?
Thank you for the question, Andrew. We are at 9.6% unaided brand awareness. We would love our unaided brand awareness to continue to grow to get into the mid-20s, which would, when we get there, likely put us as a top 10 financial institution. When I joined, our unaided brand awareness was around 2%. And for those that aren't familiar with that measure, unaided brand awareness is asked in the following way. When you're thinking about a financial services product, please name 3 companies you would consider. So it doesn't ask about student loans. It doesn't ask about personal loans or any of the other products that we have. It just asks that generic question. The ability to move it from 2% to 9.6% is really, really challenging in the time period that we have. The largest banks in our country, the most well-known banks in our country, the most trusted banks in our country, they've been doing it for centuries. And some of them less than centuries, but a very, very long time. So our team has really crushed it in leveraging a combination of branded advertising and performance-based advertising. And we absolutely partner with big, well-known stars, big, well-known entities like SoFi Stadium and innovative things like SoFi TGL. We'll continue to look for those opportunities. But I'm more than confident than ever that we've reached the point where I can go someplace and someone will say, oh, do you work for SoFi? I have a SoFi account. That wasn't happening 8 years ago. It happens all the time now. And so one of our priorities in 2026 is trying to build product quality to such an extent that we drive virality and our customer acquisition costs go down meaningfully because of word of mouth, because of referrals. We're doing incredibly well now as it relates to our return on marketing spend. You can see that in our margins. We delivered more than our long-term margin originally stated when we went public, which we've now increased directionally. So we do believe we can spend money and get a return on it. We have the analytics of that nailed down. That's what's allowing us to drive more than 30% member growth consistently over the last 8 years and coupling it with product growth. The 40% cross-buy number that is a number that's up almost 10% versus a year ago. And that's not easy to do when you're growing the business so quickly on a new member basis. So we're really hitting on all cylinders. We feel like we have the right marketing formula, but we're not going to rest on our laurels. I really want us to get that escape velocity where the amount that we spend becomes more and more efficient. And this is before implementing AI. It's really about product quality and awareness, and that filtering down to greater productivity of our marketing dollars.
The next question comes from Dan Dolev at Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great quarter and epic medium-term guidance. Congratulations. Wanted to ask you, maybe Chris, about LPB in terms of how do you think about origination specifically and how much should be allocated to LPB versus the other stuff? Thank you.
Sure. Thanks, Dan. So step back and talk a little bit about our origination outlook for the entire business. Overall, we had record originations in 2025, which were fueled by strong borrower demand across each and every one of our asset classes. What we're seeing so far in 2026 is that demand remains extremely robust, and we have more flexibility than we've ever had as a company entering 2026. We expect that total originations for the company will be up strongly year over year, and we have the luxury of choosing to drive capital-light fee-based revenue through our strong capital market pipeline, particularly in the loan platform business, as you mentioned, where we just signed a new partner, and we have several partners at final term sheet stages. Or B, we have the opportunity to keep these higher returning assets on our balance sheet and putting our newly raised capital to work. Ultimately, how we're going to allocate those assets is going to be determined by our overarching goals of serving our members and driving durable growth to maximize returns for our shareholders in the long run. Given that we have significantly scaled our loan platform business to over $14.5 billion in annualized volume, we've diversified our revenue to 44% in fees, and we have the excess capital, we have phenomenal optionality today. Holding these loans on our balance sheet results in the highest total return for each and every one of our loans, while transferring them through the loan platform business carries no risk and results in immediate revenue and cash as well as attractive returns for us. So we're really in an enviable position of choosing between two great options, and we're going to balance them accordingly.
The next question comes from Kyle Peterson at Needham & Co. Kyle, please go ahead. Your line is open.
Great. Good morning. Thanks, guys, and nice results. Wanted to touch on the deposit growth this quarter. It was really impressive and great to see. So I guess Is this still largely coming from member deposits? And then could you guys give us a refresher on what the recent downward beta has been? That'd be really helpful. Thank you.
So a couple things on deposits. I've said since we opened the bank that we have a competitive advantage in being able to offer our members a better value proposition than anyone else on something like SoFi Money. Combination of a high APY, reward opportunities, as well as other services that we provide, like free certified financial planning, et cetera. I think as rates continue to go down, our advantage will make itself more clear. Everyone that we compete against in that top quartile, they kind of fall into two buckets. One, they're a newer bank that actually does lending, and they have an ability to provide a rate above Fed funds, but they have a deposit base that's so big they can't be too aggressive because they'll reprice their entire deposit base. And that's a structural issue that we fundamentally don't have. Second is people that are not actual banks that are using sponsor banks, and they can only get Fed funds plus 20 or 30 basis points. Because we have such a large and profitable lending business, we can use those profit pools to give a rate that's unmatched by other people. We haven't had to do that yet because we've had such great demand for our product, and that's driven the deposits. And I think we'll continue to show that we can be in a top quartile APY and achieve the level of deposit funding that we want, and it remains relatively sticky. The bulk of our deposits, almost 97%, are direct deposit customers, and that is high quality primary account relationships, and that's what we're aimed at.
Yep. And the only other thing I would add to Anthony's comments, because you asked about it, is the downward beta. Since we launched the bank, we've been at roughly a 60 to 70% beta, and we would expect that to stay consistent going forward.
The next question comes from Reggie Smith at JP Morgan. Reggie, please go ahead. Your line is open.
Congrats on the quarter and strong guidance. Real quick from me, I guess it sounded like, Anthony, you sounded very, bullish on some of the new products. And I'm thinking about the crypto, I'm thinking about the stable coin, I'm thinking about the smart card. And I'm curious, do you think that the innovation that we're seeing on the fintech side could spur more interest and demand from your tech platform customers? Historically, I think you guys have led with kind of card processing and things like that. Good stuff, not as interesting as some of the newer things that are kind of coming down the pipe. Maybe if you talk a little bit about that, and if this could signal or catalyze like a change in adoption and growth in tech platform.
Sure. The tech platform business is definitely benefiting from, let me say, it could benefit from the areas that you just mentioned. So, a year ago, the amount of demand or interest that we had in blockchain, in stable coins, in wallets, et cetera, for tech platform partners was really non-existent. But since the administration changed and the OCC came out with the permissibility of crypto and blockchain among banks, the amount of interest in leveraging the tech platform services has really increased quite meaningfully. We don't have anything to announce yet. We're in tons of dialogues with different types of companies. There are companies that are launching a debit card type of product in LATAM countries that's backed 100% by stablecoins. It's not backed by fiat dollars at all. And so there's a fair amount of that. There's also a fair amount of program managers for that type of product. And then, in the US, I think there's less activity from financial institutions for those services. It's more in the LATAM countries, but we do anticipate it'll spill over to the US, and some of the international companies will look to the US because of it's a more inviting environment from an administrative standpoint. I think the Clarity Act is very important because it will establish into law the permissibility of crypto and blockchain by banks. Right now, we're all relying on the OCC's interpretive letters, and it'd be much better if it was locked into law, especially if the administration changes in a couple of years. But I'd say the outlook and opportunities that crypto provides for the tech platform, as well as our own business, are pretty enormous, and I couldn't be more excited about it. It adds a whole nother dimension of growth for us, but it also drives a whole nother sort of lens of innovation across all of our products. And when you have as many products that we have, and you have an entirely new technology platform at a lower cost, at faster speed, and it's safer, it can fundamentally change everything that we do.
The next question comes from Kyle Joseph from Stephens. Kyle, please go ahead. Your line is open.
Hey, good morning, guys. Thanks for taking my questions. On the third quarter call, we talked a lot about capital markets, and I think you guys referenced a flight to quality from investors. Just kind of looking to get an update there. Obviously sentiments change, but yeah, a little bit of a capital markets update and any implications on the competitive front on the personal loan side of things. Thanks.
Yep. Sure. Thanks, Al. So overall capital markets activity and demand remains extremely robust. We continue to see that flight to quality that we mentioned during the Q3 call. We just had a phenomenal quarter in our loan platform business, transferring $3.7 billion of loans on behalf of others. We just signed a new partner this week for 2026 LPB, and we have several other partners who are in final term sheet stages. So overall demand couldn't be better from an investor perspective. As it relates to personal loan competition, we just had record originations of $7.5 billion in the quarter. We're seeing that trend persist into 2026. So all else equal, we feel great both from a capital markets perspective as well as a borrower demand perspective. In terms of how we're thinking about just as it relates to personal loans and growth in the balance sheet, we are expecting to grow the balance sheet in the double-digit billions, which is in line with what we did in 2025. We're seeing great momentum so far here in early 2026, and we expect that to persist throughout the year.
The next question comes from Peter Christiansen from Citigroup. Peter, please go ahead.
Thank you. Good morning. Congrats on the great momentum here. Anthony, I'm curious your perspective. There's been some areas within private credit which have seen some sentiment change more recently. Doesn't seem like it's too much in the direct consumer lending portion of that area. I'm just curious from your perspective what you're seeing from some of your private credit partners and demand flows there. Thank you.
Yeah, what I'd say is the attractiveness of our assets and our loans is tied to the returns that they have, and we obviously are focused on a prime customer in the business that we're putting on our balance sheet, and mostly what we're doing with partners. And the key is to make sure we're delivering our target return against that. We've been able to manage the performance of prepayments, the performance of defaults, and the performance of interest rates and our cost of funding to deliver great value for our partners. And as long as we keep doing that, they'll continue to be in more demand than supply. With the amount of capital we have on our balance sheet now, I think you could see our growth in originations and revenue and lending start to close a little bit. In the fourth quarter, our originations were up 40% year over year, but our lending revenue was up 15%. And so we're really servicing our partners in a great way, but we could keep more of that production if we so chose, especially given our confidence in our returns.
The next question comes from Moshe Orenbuch from TD Securities. Your line is now open. Please go ahead.
Great, thanks. Chris, you talked a little bit about the allocation between the loan platform business and the core and the balance sheet for your lending segment. Could you just kind of tell us what the contribution from the loan platform business you're expecting in the 26 guide?
Sure. We aren't guiding specifically to origination volumes or LPB volumes for 2026, but what I would say is, we just exited 2025 at a $3.65 billion quarter, annualizes to about $14.5 billion of originations. We feel good about that level heading into 2026. We have sufficient demand from borrowers. Like I said, the new one we just signed up. We have all of our existing partners as well have extended their contracts and often upsized their commitments in periods. So there's sufficient demand from capital markets participants in our LPB program. But like we said, we have a very robust balance sheet, high capital ratios, and we're going to balance the allocation between the two to maximize shareholder value.
The next question comes from William Nance at Goldman Sachs. William, please go ahead. Your line is open.
Hey, thank you for taking the question. Just a lot of good questions already on the call. I just wanted to clarify the comment on the expectation for segment growth rate on the tech platform business. I think you mentioned it was pro forma for the large customer migration. Is there any way you could give us a baseline or just a jumping off point there as we think about kind of rolling forward to next quarter? And then I think separately, I think that customer had spoken about like a fairly large termination fee that they would have to recognize. Could you just confirm if that was in this quarter, or if you've already recognized that, or just how that's being treated? Appreciate the detail in the questions here.
Yeah, sure. So as it relates to the outlook that Chris mentioned, he said 20% growth for the tech platform, apples to apples without the large customer in both years. We're not going to give you more granularity than that. Our outlook assumes no revenue in 2026 from that large customer. The deal with that large customer ended. The revenue also ended in Q4, and the revenue in the quarter from that large customer was part of our contract, and it was equal to the average of the revenue in the last 6 quarters. So I think people will characterize that revenue in a lot of different ways, but the simplistic way to look at it is the revenue was tied to the ending of the contract, or revenue came in at a level that was equal to the average of the last 6 quarters. Chris, I don't know if you'd add anything to that.
No, that's spot on.
The next question comes from Jill Shea from UBS. Jill, please go ahead.
Good morning. Thanks so much for taking the question. I just wanted to touch on profitability. You've posted some really nice progress on ROTCE. I think you posted 9% in the fourth quarter. And clearly, there's a lot of momentum in the business, and you've been leaning into capital-light businesses and growing the fee income mix. I'm just wondering if you could touch on the ROE of the business over a longer-term horizon. I think you've mentioned 20 to 30% in the past. Has that changed at all? Is the timing of the past changed at all? Perhaps you can just touch on the overall profitability of the business that you're building.
So I would say this. We believe we're building a business that will have superior return on equity and return on tangible equity. We still believe it's in the 20 to 30% range. We are not going to underinvest in the business to get to that number while we're growing at the rate that we're growing. You should expect that we're going to continue to manage the business to a 30% incremental EBITDA margin, and as opposed to trying to drive it higher to maximize the ROE in the near term. Ultimately, if you see us growing less than 15% in revenue, you're going to see meaningful margin expansion and us driving to our long-term ROE. Between there and here, which hopefully I'm long gone by the time we get down to 15% from not on the earth any longer, because I expect to be here for the rest of time, unless for some reason someone asks me to leave. I hope we never see 15%. But we would be under-delivering on the opportunity in front of us if we didn't keep investing. So we're not just dropping it, all into investment. We're dropping some to the bottom line, at least 30 cents of every incremental dollar in an annual period. And that will give you a good indication of how we can drive returns over the long term. But the growth rates of over 30% that are in front of us this year at the scale that we're at just says we're just getting started. So we don't want to underinvest in that. Chris, you got anything else?
The final question we have time for today comes from Devin Ryan at Citizens Financial Group. Devin, please go ahead.
Hey, this is Noah Katz on for Devin. Thank you for the question. With over $3 billion raised in the back half of the year, you're entering 2026 with a substantially stronger capital position. How should we think about capital allocation towards balance sheet growth versus other strategic opportunities? And can you speak on your appetite for M&A? And also on M&A, please remind us of the hurdles and considerations there. Thank you.
Yeah, so in terms of how we're thinking about capital allocation, like you said, we have 23% capital ratios today. It's over 1,000 basis points higher than our regulatory minimum and meaningfully higher than the regulatory minimum plus our internal stress buffer. So we feel great about the position that we're in. we're in that enviable position where we can grow and put more assets on the balance sheet. These are very good returning assets that we're underwriting today, and we feel good about that, as well as the LPB partnerships, as I've mentioned a few times during this call. I'll let Anthony touch on anything as it relates to M&A.
There's a lot of opportunities out there, I would say more than we've ever seen in our 8 years here. But I'd also say the bar is really high for us. And when I say really high, we've looked at dozens and dozens of things, some of which were for sale, some of which were interesting to us. What we're prioritizing are things that can accelerate our growth versus the time it would take to build it ourselves. So one area we're very interested in is technology platform capabilities. And so wallets as a custody as a service, stablecoin as a service, being able to provide a market exchange for fiat and for different types of stablecoins. Our pay product, SoFi Pay, we launched in September. It is currently using Bitcoin and the Lightning Network to transport fiat dollars from the US to fiat dollars in over 30 countries internationally. And so is there a way for us to accelerate SoFi Pay's international expansion through a technology platform type of acquisition or infrastructure? We're also very interested in international countries and the licenses some small companies could have. In addition to that, in technology platform, we don't have revolving credit card processing and issuing. It's something we can build ourselves, but if there's a technology that's not that expensive and we don't have to pay for a business, we may do that and leverage our technology platform and core plus their processing to enter the revolving credit technology platform services space. There are some horizontal things that we've looked at, but nothing of interest. As you know, we've talked about building big business banking, and we looked at some SMB platforms to see if they would accelerate our opportunity there. The fact of the matter is they don't, and we're likely going to build that ourselves. Big business banking, that is, which we have seen really strong positive response from the marketplace as it relates to the need of these services to be a bank that can do both fiat and crypto. So we feel really good about having optionality on our balance sheet. I don't feel good about finding stuff at the price that we want. So far, what I'd say is it's all going to be organic. But if something presents itself in the area that I mentioned at the right price versus doing it internally, we would act on that. But the bar is really high. I know that was our last question, so I just want to wrap the call up. First, thank you all for joining. 2025 was an exceptional year by any measure. The more I went through our results in preparation for earnings day, the more I was able to truly grasp how exceptional the fourth quarter and full year are, looking through any lens, and how far we've come over the last 8 years. I could not be more proud of our team for building a diverse, resilient business that is impacting our members in an unbelievable way, and that positions us to overcome whatever obstacles are thrown our way. All of that said, I think it's an understatement to say that we're just getting started, and I am more excited about what lies ahead than I have ever been at SoFi. You can rest assured that we will move faster than we ever have, we will work smarter than we ever have, and we will be more resilient than we ever have to capture the massive opportunity in front of us. Fresh horses we ride, and look forward to seeing you next quarter.
Goodbye.
That was a pretty that was a pretty quick sign off.
Yeah. Fresh horses we ride.
Fresh horses we ride. Dude, yeah, I really liked that. I staring at the stock up 5.5% right now. But there's a lot to go through, honestly. So was there anything that stood out immediately to you guys?
Yeah, like I mean, there's a lot of things, but just a couple things real quick. One is it doesn't sound like an acquisition is anywhere near imminent, that they're going to be very selective and they're going to make sure it's the right price and right fit. I like hearing that. I think that's a good thing. I also really like to hear, as far as like, there was a small little mention, but they reiterated again that they're going to be using crypto to empower lending. That's a massive basis point and time saving. We've seen what that can do with Figure. SoFi has that same advantage, even more so since they were a bank. So like, it's going to be tough for anybody else to compete that's going to leverage across their loan platform business and their own personal lending products as well. Those are the two things that like really stood out to me. There's a bunch of other stuff too. I love the color on the loan platform business. They signed a new partner this week, that they have many that are like really close to signing as well. And this isn't just like hype, like, big bank pipeline stuff with tech. No, we've seen a meaningful increase in that. So the cadence of this should improve. And I like the last little bit, and that you mentioned that they're going to execute faster. I mean, we've seen that since last fall. If we continue to see that this year, this gets very exciting.
Yeah. The thing that stood out to me, I actually didn't think they were going to answer it. The individual segment level 2026 expectations. They said lending revenue is expected to grow at 23%. That is way, way higher than I thought. I didn't think we were going to get into the 20+% ranges. So right now, with the additional capital, while they potentially are eyeing some, potential acquisitions and ones that we have highlighted before, like the ability to help with credit cards on the loan or on Galileo and stuff, which could be very interesting. While that cash is sitting with them, they're going to do exactly what they normally do with that money, and that's lend it out. So 23% growth there, 40+% growth on financial services, which, based on the commentary that they said with the loan platform business, we just signed a large new partner and have several partners in the final term sheet stages. I thought that was quite interesting. So it probably gets above 40% with the advent of crypto and all their other products that they're pushing. And then the tech platform, as we were just sort of saying goodbye to this line, this product line, as it was coming to its final days, said 20+% revenue growth. And it's, they're looking at that after Chime revenue. So that looked really, really strong. They said they were going to sign a massive client here in Q1.
Help me understand that, because I want to make sure I'm getting this right. Are they saying 20% growth? If you just take away Chime completely, like that those numbers were flat, or are they saying despite losing Chime that they will still grow 20%?
They said it's normalized, so it's as if there was no loss. So it's 20. It's a good 20%. It's not a bad 20%.
Yeah.
Yeah. As if Chime was never there.
I do wonder who that's going to be, though.
Yeah, somebody big for sure.
Well, I don't think it's just going to be one client, but I think that they are in the final stages of signing a very large client. But I don't think that there's going to be a client that makes up for 20% growth.
It could be. I mean, look, they've said they want to move towards bigger deal sizes that are more sustainable. So it could absolutely be a single client. Maybe not, but it could be.
So if it is it a bank or is it somebody that's leveraging crypto?
I don't think it's crypto because crypto. It's too, you got to keep in mind their deal cycles for these are very long, and crypto just came back in it's been 2 quarters, 1 quarter. It just came back this quarter, so I don't think it's anything to do with crypto, but maybe a bank, or maybe it's honestly outside of banking completely. Like they've been signing a lot of rewards platforms, hotels, airlines. So,
but a lot of those are, some of the biggest names in that space. Like Wyndham Hotels is one of the largest companies for rewards in the world.
United, Southwest,
T-Mobile.
Yeah. So which individual customer blows all those out of the water? Like, I don't know. But so it probably is a large bank, We didn't hear any commentary about a top 5 or top 10 US bank. That, that sort of commentary faded away a little bit.
Good. Yeah, if it happens, great. But the other thing that was a surprise for me was their read on the macro, their assumptions. 2 rate cuts, 2.5% GDP growth, which is exactly what Goldman Sachs put out, and their unemployment number. I don't remember what it was exactly, but
4.5 to 5.
Instead of it being like super, bearish relative to the consensus is out there, it's actually in line. So that's really interesting.
Yeah. It's interesting too, right? Because you got to keep in mind they have PSUs in June. I found the final answer was really insightful. I think he went in depth more so than he's ever done on their M&A exploration process, let's say. And he talked through a bunch of different potentials for
Yeah.
what parts of the business they could accelerate through inorganic growth.
Almost exclusively on the tech platform side, aside from big business banking, which they said there's really not an option. Like we almost have to build it internally because there's so few players in this space. But no, by the way, I don't think any of the large clients or anything, if we do end up getting a bank, is going to be JP Morgan, Bank of America. I don't think that. If we do see a massive bank, maybe Citi, maybe Wells Fargo.
One thing he did say, Tanner, he said, quote, "We're also very interested in international countries in licenses. Some small companies could have that." So it brings up the question like, hey, is 2026 the year where they do more international expansion through acquisition?
Yeah. I don't know, man. Either way, like I don't know the exact direction that they're going to go in, but I do believe in management's decisions. Clearly, it's led us to this direction, and hopefully, the market is excited about the 2028, numbers. Now, the only thing that I need to clarify on, and I wish that they didn't do this because it's just kind of making me a little upset, is that they said the range that they're putting in for midterm guidance is 2025 to 2028, which includes the great numbers that we saw from 2025. So I think if they didn't include that, it would actually be sub 30%. So I think that they included it to get above those numbers. I think that's a little bit of what guidance includes numbers that have already been seen. That's not guidance. So that part is a little bit meh. But still, numbers way higher than what Wall Street is currently expecting, even with that adjustment.
Was that, you were saying that was for the revenue and EPS numbers?
Yeah, all of it for midterm guidance. So 2025 to 2028. So they're assuming the full growth of 38 to 42% is the compounded annual growth rate average of year 2025, 2026, 2027, and 2028. That's the way that I read it. I mean, there's no other way to read it.
That's the transcript on quarter. I looked, I heard it wrong, and I put 26 or 28 because it is a little bit weird to have numbers that are already there.
It's not just in the transcript; it's in the press release.
Yeah,
like it's written down. But yeah, so that's a little bit weird. But the broken down expectations for 2026 are great numbers, and hopefully they end up. I ended up hearing there's a small loss share provision in the loan platform business. Not a fan of that. That kind of puts us in they said small. I'm sure it is small. Maybe it's one client, one small one. And they're very, very, confident. But that sort of puts us in the league of the upstarts and stuff like this. That used to be a thing that I used to say to make fun of upstart. And now SoFi's doing it. So,
interestingly, we should get a press release this week because The Point said they just signed a new LPB client or partner.
No, I don't think we're going to see anything.
You don't think we're going to get a press release for that?
No, we've the amount of loan platform business deals that or like just the total originations is way higher. I think it's like 60 or 70% higher than the press releases that they've been releasing. So most of their loan platform business customers are completely not talked about.
Yeah, it probably depends who it is and their own individual preference as well. But yeah.
If it's some public company that's going to benefit from that press release coming out as well, like a Blue Owl or something like this, then, I mean, aside from that, I don't think we see anything. But, they're in the final stages of multiple new partners, and the percentage of overall originations for personal loans versus the loan platform business hit another new high at 48%. So 48% of all personal loan originations go out the door and immediately does not touch SoFi's balance sheet. That's insane. And the lending, 23% growth that they ended up highlighting, 0% of that is the loan platform business. But if 50% of the loan of the originations on personal loans are going out the loan platform business door, it makes you think that like there's not a chance financial services is only growing at 40%.
Yeah.
Because, you know, a large percentage of that growth that they're expecting in lending is going to go into financial services.
I want to add something. The guidance 25 to 28.
Yeah.
You said it's weird that they're taking 25, so I went back. The previous one, they did the exact same thing. Q4 2023, they gave us guidance for the 2026 period, the 25% compound revenue growth for periods 23 all the way to 26. So they always take the year that was just behind them and they include that in that midterm guidance.
But what's the exact number? You know, if they're giving us a percentage, give us a number. Is it $1.30? Is it $1.50? Is it $1?
I guess maybe now it's a bit too soon, but yeah, previously they did give us like that 55 to 80 cents gap earnings per share. Now we're not getting that. We're just getting the expected growth rate, but they've always included the year that just passed in that guidance. So I guess in this case we can just do the math ourselves, which reached, what did I say, between 1.08, I think, midpoint.
I don't know, but the numbers that I gave on revenue for, you know, the 8+ billion or whatever, that's likely not actually to be the case if it's inclusive of 2025.
Yeah, no, so it's 7.9 billion.
No, it'll be lower than that.
Lower?
Yeah, because the like you're compounding it at a 30% rate. But it's not compounding at a 30% rate because 2025 is a higher percentage of that average. So here, what was total revenue? Grew at 37%. So it's 7% above that CAGR. So meaning that the other parts will actually be, you know, it might be compounding at a 28%, 27%. I don't know what the exact number is, but if it all CAGRs out at 30% and we already have one of the data points way above that average, that means the rest of the numbers need to be lower than the average.
Yeah, I mean, okay, so we just have to take the number that we had before and then start doing the math. Okay, fine, yeah.
Yeah.
A bit strange, I admit.
Yeah, that's all. That's the only thing that I'm nitpicky about.
Yeah. Yeah, it's not sketchy. It's different, but it's not different for them.
Yeah. It's sketchy is the wrong word. It's just don't think of this as 30% forward.
Yeah.
From here on out, yeah.
I put a post out there on X, and I had to add like, oh wait, no, that's 2025. So thanks for that clarification, Tanner. I didn't catch it when I was hearing it.
I didn't catch it at first either, and then I'm like doing all my guidance and, you know, filling in all the spreadsheets and stuff. I was like, this actually doesn't look right. And this is why you write down, like, whenever you guys are listening to these earnings calls, it's always great practice to, you know, take good notes and use spreadsheets and stuff. Because, like, I don't know, my brain is not that good at keeping all this information. But once you start writing it down, you start filling in the gaps.
Yeah, I actually I followed along the call on the Quarter app. It doesn't record like everything in the transcript; it just automated. But it really helped when I was like, "Wait, did they say that?" And sometimes I was like, "Oh wow, they said that," and I was like, "Oh no, I heard it wrong." So it's early, easy to miss things, and there's so much going on. But yeah.
Julia is suggesting that 2025 is the base year that they're setting the 3-year growth rate on. It's a 3-year CAGR. I don't think that is the way that it's like. It very clearly says, where is it?
It's a good question to IR. Who wants to ask it?
I mean, maybe she's from 2025 to 2028.
It would be a little different way of wording things. It's possible.
I'd say from 2026 to 2028.
Not a huge deal either way, but it'd be good to know.
Yeah. Okay. Regardless,
it says at least. So,
by the way, this is a
higher.
quick email to the investor relations page that they can clarify for us because that's public information. So, just what did you mean by this? So we'll probably have that answer by tomorrow.
No more warehouse lines.
Yeah, I
Fully
was
paid
looking
down.
for that.
It's yeah, hold on. Here, Vadim posted about it. Share my screen. Doesn't even show.
Yeah.
Vadim said, yeah, no, they have enough funds that they no longer need to rely on warehouse facilities and pay higher cost of funds for it. And Lapointe talked about this. The exact quote is around the $1.5 billion raise. Over the past 2 quarters, we fully paid down our warehouse lines, reducing our funding costs by an estimated $110 million on an annualized basis, fully mitigating to the bottom line the impact of additional shares.
When's Berkshire going to start buying? I don't think they'll be buying this name, but I mean, they could. It's also way too small. They don't buy a lot of $30 billion businesses.
Yeah, they had Nubank, but they even sold out of that a while ago.
Yeah. They got that actually at pretty expensive price to what you were able to buy it at, and they never ended up buying the dip, which is hilarious. They bought it in the Series F, and then during the IPO as well at like $10, then dropped down to under $4. They never bought the dip. Okay. Overall, guys, if you could rate this quarter out of 10, going down, you can use decimals. Don't get crazy. What do you guys think overall this quarter is in a balance of risk and reward? Tevis?
8.
8 out of 10?
Yeah, and the reason why is like I think tech platform was still not strong. I know we say it all the time, but decline on a members 122 million, the chime costs and whatnot. We expected higher, but I think they're doing extremely well on loan platform business. Great guidance, even though it's conservative. New product offerings, and I think the call was terrific. I think the call was very, very good. So yeah, 8 for me.
Neil?
I was about to say the same thing. I think 9 is a bit too high and maybe a bit too like a super cheerleader effect, but 8 seems fine. 7 is too low, 8 seems fine. Plus, it's the start of a new year, so they should be setting realistic targets, and based on their track record, I think they'll do just fine. I'm still going back and forth here on this 30% CAGR thing and trying to figure out if we are wrong or if it makes sense, if it's including 25 or it's I don't know. But
if it's not including 25, bro, this is perfection. Like we can talk a lot of crap about the technology platform, but they guided for 20% growth. Like that alleviated all my fears.
Yeah. Either way, it's at least 30%. And if you go back 12 months ago, they also said at least, 28%? I don't know, for the member growth. And that came in much, much higher. So in this case here with the at least 30%, I assume it's higher than 30%.
Roy?
Yeah, I mean, I can't disagree. I think an 8 is a good solid number. It is a very good earnings call. Very good. The call itself was like fantastic. The call, I'd give them like a 9.5 easy. The actual results were an 8. Guidance was really helpful, really strong. The only weak point, we already mentioned is tech platform. They gave us a lot of details that we didn't have before. I thought that they were going to originate a little bit heavier on the personal loan side. They still are. So very good quarter. I think that we will see better this year, but this is very good. Like if we just see 4 more of these, I will take it gladly. These are great.
Yeah, there's definitely going to start being some more concerns. I bet you could see an article come out within the next week from Giuliano Bologna talk about how personal loans this was a bad sign for personal loans because they're starting to reach saturation in the market. That they have such a large percentage of the overall written amount of originations on personal loans that it's just hard to continue to grow at this rate. But Anthony Noto ended up trying to squash that immediately during the call, talking about how it's not a $150 billion industry, which is sort of the U.S. personal loan rate, but really an over $1 trillion industry for credit card debt consolidation in general. So, and then also just the amount that they talked about home loans, first home buyers, the cross sell there. You can see them switching into potentially a new favored product. But ladies and gentlemen, we have 5 minutes until the market ends up opening. The thing is just switching here, but do we open up? Do we see any egregious candles, or do you think it sort of stays where it is into the open?
By the way, Chris Hager said medium-term guide is 30% CAGR from 25 onwards. Does not include 2025's growth in there. So the starting point is 35.91 from
okay.
FY 25.
All right, that's my B. You have to go and recorrect your tweet, Roy.
Yeah. I didn't edit it. I added a comment, and I'm going to delete it now.
Saying also
Blame
the tech
me.
platform. He also says the tech platform guide is 20% growth from 25 levels if you take Chime out of 25 revenue. So 20% growth X Chime. Just a point of clarification.
Which is what we
thought.
Which he gave us a lot of clarity on that as well. He said that they paid the average quarterly revenue over the past 6 quarters, which was $33 million. That's a massive customer. And I guess that's why, as they're dropping off the platform, we're seeing negative 30 million customers. But also 30 mil, if that's all just Chime, I don't know. Maybe Chime has more customers than we think, because I think they're reporting active customers at 9 million.
Well, what we don't know is what that contractual obligation looked like. Did they sign an agreement that was for 3 years out through 2028? So this could be a multi-year early exit as they shift to Chime Core.
Yeah. Which it was an early exit. We know that. It was an early termination. And not because they didn't like Galileo and they went to another provider, but instead they built their own service in-house, which they were doing for multiple years.
Yeah.
And by the way, there were 2 other clients that tried doing that before that have come back to SoFi. So we'll see.
I would be surprised if Chime does, but yeah, maybe.
That one in particular, I'm not so sure if they do come back, but I know that they've been in talks with some customers from previous quarters that they talked about that, didn't realize, didn't know how much you loved her until you let her go.
Yeah, and today, it's just one day stock price action. The macro is pretty red. We had an inflation read that didn't go the way the market was expecting. So this could do anything, but just keep in mind relative to what's happening in the market. If the S&P 500 was up 2% today, which would be crazy, SoFi would be up a lot more than where it is right now. So if it goes down, one day. What is clear though is there's a lot of confirmation of the long-term thesis that it's not only intact, but it's accelerating. It's a really good read.
Okay, we'll see if in the next minute and a half or so, if it's party time or if the 90% of chat from yesterday and all the weeks said that it was going to dump. I'm no screenshot Sally, okay? I'm not going to put all you guys on blast for saying that we're going to have a bad freaking time here, okay? But I am hopeful.
I got to bounce, but thanks for the stream and thanks for watching, everybody. And
you can't stay 50 more seconds?
I got a job, Tanner.
I'm off today, so I'll stay on your behalf.
See ya.
See what that he doesn't have the love. He might have the conviction in his portfolio, but not in risking his day job, and that's what it takes to be here for the SoFi community.
Yeah, I'm just so thankful they actually did the earnings call for me on Friday instead, and I'm sure it was just for just kidding, but yeah, it makes it easier to actually follow this.
Roy and Tevis, these guys have jobs and they're not dedicated. Me and Neil, fully unemployed. We're here for you guys.
That is true. That is true. Remember the EPS comments that they gave us a long time ago? The 20 to 25% EPS growth beyond 2026?
By the way, the market just opened. I don't have a bell to ring. Ding, 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 ding. Actually, I have a water bottle.
Wait. I have a gong.
There you go. Gong it. Market's open. That's so depressing, by the way. The gong sucks.
It's red. Throw away the gong. Yeah, well, the one thing that happens on a day like this too is, I saw a lot of people that said, "Oh, the market's really weak and it's like gonna crash. If we even are up like 2%, I'm selling." And so there's people that'll take profit. There's a lot of macro stuff too, so anything can happen here today.
The question is, why would you even sell?
I don't know. I'm not going to be mad. $25 cash secured puts that I wrote for today. I'm not going to be mad if those fill at all. I may even just turn around in the after hours and take some of that doesn't fill and buy here.
So, guys, the only thing that's really blowing SoFi out of the water right now is SanDisk, and I mean deservingly so. If SoFi put up those types of numbers, I would have been retired. So SoFi, it's not looking good, but the market, as you can see, one of the best performing things on this watch list is the VIX. That's not what you want to see on earnings day. So it is selling off. I was making fun of Tevis. He might have been right. It's so sad.
Yeah.
So I was also right, technically. Okay. All good.
Look at me with egg on my face.
AMD is down probably because NVIDIA only got the clearance to sell chips to DeepSeek and not AMD or something like that.
I don't know, maybe.
So
Anyway,
one of
anyways,
the I wanted to
everything's
share
down, so.
one thing too. Like the earliest note that we had from an analyst was William Blair's Andrew Jeffrey, and he said SoFi easily beat Q4 revenue, and he's very excited about it. He says that suggests that the company does not have enough investment opportunities to keep profitability down, and said the future of banking is SoFi. And he called the first quarter a blowout and believes that the company's accelerating KPIs suggest an awareness inflection. And so they have a buy rating that's very strong rating. So,
yeah. I'm going to do my part and buy some more SoFi. This is what I feel is appropriate whenever you find a multi-year 30% compounder that sells off into good news. But yeah.
Yeah. It's kind of a typical SoFi. Well, the other thing that probably didn't help too is they exacerbated the pattern of the sell-off, with the dilution, which a lot of people were fearing, which is unsubstantiated today. But I think some people are like, well, if they do, I want out. So and I'll buy later.
Sorry, say that again.
There were some people, a lot of people were focused on the idea of dilution and saying they're absolutely going to dilute again, which is ridiculous. They're not going to do that here, especially given the cash that they have on the balance sheet.
Yeah.
But, there are a lot of people that were wanting to take some gains and saying, hey, they're going to do what they did before and they're going to dilute us right after earnings. And so we're going to take a quick profit, get out and buy lower. I think that's getting, maybe you're a trader, and if so, that's fine. But if it's a long-term investment, that's just getting too cute over short-term moves. And it's easy to, especially on like a really strong earnings like this, to see that reverse in a hurry. And we're seeing a reversal right now.
Dude, look, like this stock is manic.
Yeah.
I mean, we fell to 0%. And then now we're going to break above 3% again.
Yeah, it'll be pretty volatile today. And honestly, if people in the audience and ourselves included are long-term investors, the best case scenario, assuming you have some cash or something that you can sell elsewhere and put it here, would be like, let's say we have this exact earnings, the market is still doing exactly what's here, and SoFi just for whatever reason starts trading at $10 a share. Like that'd be like, okay, this is crazy what's going on, but also like, this is crazy. I'm going to buy a whole bunch of SoFi. I'm just going to hold SoFi. That's an extreme, but it's an argument from absurdity. But it's just kind of showing like selling off after a strong earnings. Most of it here is just because of macro. It's not the worst thing for long-term investors. It's not fun, but
Bro, look at this right now.
Yeah.
I mean, the PPI report did not help at all.
Yeah.
I didn't even see what
came in hotter than expected. Way,
yeah.
way hotter than expected, actually.
Yeah.
So what's the general market doing right now? NASDAQ down 0.3%.
Not bad.
Here, wait, let's actually just do it here. Not soy, I want SPY. Red on the day right now, potentially turning green. QQQ's down 0.3%. And back to SoFi, red.
Yeah, if SoFi underperforms PayPal today, I'll be scratching my head on that one.
What's PayPal at?
Negative
probably
half.
20
It
or
always
something.
Yeah.
On PayPal, Neil, you think we see below 50 prices?
Never say never.
The lowest since 2017.
I still think they beat on Tuesday.
They do.
I just hope they are very well caffeinated when they go on the call and they stop with their, everything's bad and it's weak and blah, 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 because clearly everyone else is saying that the consumer is better than feared. So
yeah,
we'll have to wait a couple of days.
They need Jamie Miller to just like have an IV with caffeine like straight into the veins. So she is like pumped and ready for that call. And then they'll be good.
Send her a couple of Monster and Red Bull cans before the call.
I mean, I'm telling you, like, yeah, I got to get my brother on these.
Yep.
None of that weak Celsius stuff. Real men drink Monster.
And the worst thing is that they will be excited during the call, just like 3 months ago, and then they'll go on analyst conference calls, and they're like, "Oh no, it's all going down the drain." Despite us being very happy with Buy Now Pay Later, Venmo, branded experiences, and all of that, but
and they're hiding advertising, but it's ahead of schedule. You know, all the reads that we have from Grayther, and that's like a high margin product. So. Yeah, for the audience, Neil and I will be covering that live on Tuesday morning. I do have a day job, so I'll have to do an out right before the market opens. But we'll cover that call live together, and we'll get the link up there relatively soon.
Yeah,
so we can all commiserate together or celebrate.
Exactly.
Yeah, PayPal should be fun. Full year guidance is always exciting. It makes Q4 the most exciting quarter for almost all companies. But why did Tanner lie to us? I know, it's crazy. It's crazy, dude. I'm disappointed in the stock reaction here. I mean, at the end of the day, though, like, it doesn't change anything about their performance unless I'll look out for analyst reports, which we're already starting to see some, like Andrew Jeffrey.
He's a good analyst too.
Yeah, I had him on the channel. He's a great dude. I'll have to have him back on so we can talk some more SoFi.
I do wonder what,
Andrew Jeffrey ended up reporting, and so did Mizuho, Dan Dolov, but I haven't got the email yet.
Yeah, it looks like at this rate, I'll be owning about 20% to 25% more SoFi after today with those cash secured puts. So I'm good with that.
Oh, I got Andrew Jeffrey's full report here. Blowout is what the title is called.
Yeah.
Accelerating KPIs suggest awareness inflection, maintain, outperform. SoFi easily beat fourth quarter revenue and EBITDA and guided for 2026 EBITDA to 1.6 billion, well ahead of our 1.4 billion dollar. Sorry, I adjusted that. It was 1.385 billion dollar estimate. Implied roughly 55% incremental EBITDA margin, suggesting the company does not have enough investment opportunities to keep profitability down. 1 million new members versus what? They got 1 million new members versus our estimate of 228,000.
What? What were they expecting?
I don't know. 40%.
If we had that member read, I'd be like, okay, something terrible has happened.
Yeah.
Those would be the worst quarterly numbers in, I don't know, a long time. Boy.
Yeah, you should have called me before you posted that, Andrew. I would have given you the deets.
Hey, Robinhood is up 1.3% today, so
yeah. Well, that one's funny. Like, I saw it rise after hours because of the Trump account stuff, and I'm like, the market is sometimes just stupid. Like, why is this a shocking thing? It's like, okay, Vlad was one of the guys that was instrumental in getting this push through. Robinhood has an amazing engineering core and tech stack, and their demographics naturally line up with, because I mean, it's a younger audience. They're in childbearing years for this exact product. It's like, they're going to be a big winner here. And the market's like, we forgot. What are you doing? They're not going to be the only winner, but yeah. And to be fair, like Bloomberg's take that published last night, it is a little bit more robust than even my expectations, but still, it's a little silly.
Really quick, I just want to read this thing. This is emboldened on, or bolded on. I don't know how to say that, okay? Andrew Jeffrey said, "We're pleasantly surprised by this outlook and think the street will be too. This is it's bolded, okay? We encourage investors to add into strength this morning. Yeah. SoFi's results seem to support our thesis that large banks that have aggressively penalized customers for holding deposits at their institutions and slap them with unreasonable fees are losing the day. In our view, the future of banking is SoFi." That was their quote, down 2%. Crazy.
Yeah. You know, the S&P 500 is just barely down too. That is really surprising. So I don't know. Short-term moves, though, they can oftentimes be erased either way. So,
do you think that this stock? I thought about this. Like, do you think big money will try to protect this stock from the dilution of the PSUs and just essentially hold it under 35 until after Anthony Noto and Crystal Point can't get paid, so then it doesn't help dilute the company even more?
I don't know about that. Like, if we get close, possibly, but we're so far away. I mean, for both on the price standpoint, for the weighted average, and also as far as time. So, yeah, I don't think so.
I mean, we act surprised, but I don't think we are surprised. Right? This is not the first time that this has happened, where SoFi beats across the board, and it happens to be on a bad day for the market, and so we are going down. In this case, it really is. Like, the moment they said they're going to report on Friday, I knew something was going to happen, because who reports on a Friday morning? I don't know, but it's not the first, definitely not the last time. I hope it's the last time, but I don't think so. Where SoFi reports great numbers and the stock gets dragged down for a day or two, and then it starts to go back up. If we look at the past 2 years, I think it's exactly what has happened.
Yeah.
But at the end of the day, if we're getting 30% compounded growth, I'm not going to complain here at all, and even more for EPS, of course. So, yeah, well, the market will do what the market will do, and I'll happily accumulate more shares.
Oh yeah, it's right there around my cash secure put level. So I'm like, oh man, that's I don't mind that at all. Give me those shares.
Okay, are we ending this?
Yeah. Goodbye forever. No, just
enough red for the day.
Yeah.
I don't think there is a specific reason why a AMD or a Nebius or Iron or Shopify are down. I think it's just sector-wide.
Jose's just being a dick.
I see a green candle.
And it's gone.
It's somewhere here. It's all right, bro. Go hold SanDisk, okay? We don't want to hear about it.
I mean, I have Micron, and that thing is up 3.6%. It's like this thing goes to the moon every single day.
All right.
Crazy stuff.
Ladies and gentlemen, thank you all so much for watching. We'll see what happens by the end of the day or throughout the next couple of weeks. But all I have done since, the day has started was buy more shares. That's my motto here.
Bag holder.
Yeah. All right. Thank you all so much for watching. Really do appreciate your time. But bye for now.